In this lesson, we're going to talk about some of the misconceptions of trading and tell you not only what you can expect from this course, but also what you should expect of yourself. Let's start with a simple expectation. You can expect to work. Many people think they can take one class and instantly become a top-notch, world-class trader. Not true. It takes a lot of work. Now, once you understand the strategies, it can get a lot easier, but you still have to put in the work. That means taking lots of notes. As you progress through the course content, whether it's self-paced or in a physical class, take notes about what the instructor is talking about. If you have questions, ask those questions. More importantly, participate. Make sure you complete all exercises. If something isn't clear, keep asking questions until you get it. And finally, practice. There's an old phrase that says repetition is the mother of all perfection. It takes a lot of practice to make a great trader. So watch, pause, rewind, take notes, and make sure you understand each lesson before moving on. Some people think of trading as gambling. It's not. Trading is a game of probability. But if you trade without a plan, without rules or a strategy, then it really is gambling. We're going to teach you to make informed decisions based on price action, helping put the odds of success in your favor. This is a bell curve, one that represents probability. As we scan for trading opportunities, we will be analyzing them using specific criteria, which will help us to identify high probability trades, low probability trades, and trades we should simply forget about and move on. To explain the concept of putting the odds in your favor, consider a simple dice game. You have a 6-sided die, and you pay $1 to play. You pick one of any of the numbers on the die, which gives you odds of 1 to 6. If your number is rolled, you win $5. Well, with those odds, if you keep playing the game, you'll be lucky to break even and most likely lose money over time. It's just built into the probability of rolling the die. But what if you play a different game? This one still costs $1 to play. You pick any number, and if you're right, you still win $5. But this time, it's played with a 4-sided die, which now gives you odds of 1 in 4. Keep playing this game over time, and you're eventually going to win and make money. That's essentially what you look for and consider as you plan out your trades. Which ones give you the highest probability of success? Thankfully, there are a lot of different metrics to help you answer that question and target those trades. Some of the things you will be looking for and considering are market timing, supply and demand, price, and the trend of specific securities. You'll be looking at institutional actions. What are the big firms doing with their money? You'll also run through a series of odds enhancers to evaluate criteria that help put the odds of successful trades in your favor. You'll learn about risk management and how to develop a trading plan. Each one of these is critical to your success and helps you refine the trading process so you can avoid high-risk trades. In a perfect world, all your trading accounts would look like this. Perfect, 10 successful trades out of 10 trades, no losses, said no trader ever. The truth of the matter is that your trades aren't going to look like this. You may go on a run and have 10 winning trades in a row, but over the course of time, you're going to take some losses. What you don't want to happen is what we call the novice trader's world, where you have a series of nice wins followed by a few devastating losses. Here's an example. This trader had 8 wins and only 2 losses, an 80% success rate. Amazing, right? You probably think they're making a ton of money. But those losses were big ones and the result of bad trades. Without risk management and a trade plan like experts and professionals use to prevent making risky trades, those probabilities catch up. And this novice trader ended up in a sharp decline, giving everything back up to the market with just 2 losing trades. That's the sign of an amateur, and we don't want you to make those mistakes. A professional trader's world looks something like this. 4 wins and 6 losses. That's 10 trades with only a 40% success rate. Now, most people would probably look at that record and think, that's not good, that's less than 50%, that's a bad trader. That's not necessarily true. You may be asking yourself, how is this possible? How can a trader have an increase in their account when technically they are right less than half of the time? It all comes down to money management. Here's why. With any trade, there are 5 possible outcomes. You can have a large profit, a small profit, a trade that breaks even, which is getting out of a trade at the same price you got into it. You could have a small loss, or you can have a large loss. Those are your 5 outcomes. But if you eliminate the large loss outcome, you now have a formula for success. You're keeping your losses small, preventing your account from taking a large loss, and leaving it wide open for profit. So why do traders let a large loss trade happen? It's because they fail to use money management. They don't use a stop loss for fear of taking a loss. Ironically, that fear can lead to much bigger losses. Or maybe they are buy and hold investors who believe that markets will only go up over time. These are fallacies that you have to remove from your thought process altogether. You will learn a lot about stop losses in upcoming lessons, as they're crucial to maintaining and growing your accounts. Along with stop losses, the components of risk management include position sizing, money management, reward to risk ratios, security selection, and market correlation, and even more than that. You're going to learn about all of these things. What does implementing these components of risk management do for us? Longevity. The most important thing to remember is that trading is a game of longevity. Even if you want to trade short term or become a day trader for daily income, you still need to think about the long-term picture. Over a period of days, you probably won't see huge changes to your account. Over the course of a couple months, you may see more significant changes, but it's really the year-over-year changes that really matter. You should see your accounts grow right along with your skill sets. How can that longevity be achieved? One of the single greatest factors to a trader's success is having a plan. Here's a visual of a well-constructed home. It was constructed according to very specific plans, a blueprint. Because who wants a home built without plans? If you tell a contractor to build a home with 3 bedrooms and 2 baths, you can't complain when the result turns out to be not what you want. You didn't tell them exactly what to do. You didn't have a plan. In this program, you are going to build your own personal trading plan. We have a blueprint in place with very specific instructions that explain how to study the markets, formulate trades, and then follow a step-by-step process to analyze and execute those trades. By sticking to your plan, you should establish a P&L curve that continues to move up with very small drawbacks. If you don't have a plan in place, you have no idea what you're going to get, and most likely, you're not going to be happy with the results. Another thing you can expect in this course, you can always expect to be learning. You will learn from your teachers, from your mistakes, your successes, your mentors, and most of all, you'll learn from your trading community. The markets are an amazing entity. They're constantly changing. One moment, it could be a bull market. The next moment, it might turn bearish. Markets can suddenly go flat with little range. The next moment, the market might be volatile with massive ranges. These types of market changes require education and knowing exactly which tools and resources to use and when. As you go along with us, make sure to use as many resources as you can and be ready to put in your best effort. They say that life is what you make of it. The same goes for our classes, so immerse yourself and achieve the maximum results. In this lesson, we're going to go over some terms related to trading and investing that you're going to be using throughout your education here. Why is it important? Well, to communicate and trade effectively, you need to know the language of trading. Now we can categorize these terms into demand and supply. If you think about it, the only 2 things that anybody can do in a market is buy or sell. So if that's the only input coming into the markets, buy orders and sell orders, that must be what's creating the output or the movement of price. So for this reason, that's the lens through which we will view the markets, through buying and selling or supply and demand. Now, the name of the game here is buy low and sell high. The only way that anybody makes money in business is buying low and selling high. But for us as traders and investors, we can first buy and then sell later at a higher price to make a profit. But we could also sell first and then buy later at a lower price to make a profit. That's kind of a foreign concept to most people, and we'll talk more about that in detail later in the course. But just know that we have that option available to us. Now, on the demand side, we call a good place to buy, a good window of price to buy in, a demand zone. And the way that we make money here is that after we buy, price goes up and we sell at a higher price. The expectation is that at a demand zone, prices will turn and go to higher prices. Now, this makes sense because if something is in high demand, a product is in high demand, it means that a lot of people want to buy it and prices will start to go up. Think of that really hot neighborhood that a lot of people want to move into. We're going to start to see home prices rise in that neighborhood. This type of trade, where we first buy and then sell, is called going long or a long trade or a long position. Now, on the supply side, we call a good place to sell, a good window of price to sell at, a supply zone. And the way that we can profit from this is by, after selling, prices dropping, and we buy it later at a lower price. The expectation is that at a supply zone, prices will turn and go to lower prices. To put it into perspective, think of a store that has a bunch of t-shirts left over that have not been selling. They're not in high demand because not a lot of people want to buy this product. So we've got lots of supply and no demand. What's that store going to do? Well, they're going to start to mark down prices. They're going to put it at a discount, maybe even throw it on the clearance rack. So when we have a lot of supply, we see that prices go down. This type of trade, where we sell first and then buy later, is called going short, or a short trade or a short position. You'll often hear this referred to as selling short. This works the same in the business world. If you think of any big corporation, they're looking to buy at wholesale prices and sell at retail prices, or buy low and sell high. Our goal as traders and investors should be exactly the same. Use the charts to determine when there's a good wholesale buying opportunity or retail selling opportunity. Conventional technical analysis will refer to a good place to buy as support or a good place to sell as resistance. Now, all that support and resistance are lines on a chart where price was unable to surpass in the past. But a line on a chart is not what's actually causing price to go up or down. Our approach looks at the concept of support and analyzes it for strength. That strength is a result of demand. The more demand, the more likely prices are going to move up. Therefore, demand is the real support and represents the best place to buy. Conversely, resistance doesn't tell us much, but rather, when we identify areas where there's an abundance of supply, the odds of price dropping are greater. Supply is the real resistance, the reason why prices go down. The turning point that we can expect to see on a chart at a demand zone is a bottom or a low, and at a supply zone is a top or a high. A bottom is where price stops dropping, turns, and starts going higher. A top is just the opposite, where price stops rallying, turns, and starts going lower, creating a peak on the chart. When trading and investing, you're making and losing money, sometimes very quickly and sometimes not quick enough, depending on what you're looking for. Fear and greed definitely come into play when this happens. The emotion associated with buying or prices going up is greed, and the emotion associated with prices dropping or with selling is fear. This goes along with the buy and hold mentality. What we mean by buy and hold is, for example, buying shares of a company and holding on to those shares for a long period of time, hoping that in the long run, prices will go up, this company does well, and you'll do just fine. Now, most people are not aware that you have the option to sell short. In other words, the option to sell first and then buy back later to make money as prices go down. Most people only know about going long or buying, hoping prices go up and selling later at a higher price. For this reason, that's why greed is associated with prices going up and fear with prices going down. Because if all you did was bought something and you start seeing prices drop, you're fearful. You're panicking because you're losing money. But of course, as prices go up, you're feeling good. You're feeling greedy. You become a green cheerleader with pom-poms and everything. The color associated with buying or prices going up is green, and the color for prices going down or selling is red. You'll see these colors all over the price charts, the transactions and orders you take, all over the trading platform and many other places, always assigning green to buying, going long, prices going up, and red to selling short and prices dropping. These are industry assigned, but you'll see this color coordination throughout your education here as well. So this is your vocab list. You'll be asked to use each in a sentence in the next lesson. Nah, just kidding. But these are the terms related to demand and supply that you're going to become very familiar with throughout your education. In this lesson, we're going to talk about the terms bullish and bearish. Bullish refers to a market where prices are going up with a bias or expectation of higher prices, while bearish refers to a market that's going down with a bias or expectation of lower prices. The terms bull and bear are thought to derive from the way which each of these animals attack their opponent or their prey, and it gives us a convenient way to remember the difference between bullish and bearish. A bull will thrust its horns up into the air to attack, while a bear will strike downward with their claws. So if the bulls are in control, then market prices are generally going up. Even if not every single little tick of prices up, overall the movement of prices is upward. A bullish market implies that we are in an uptrend. A market can be referred to as bullish, or you can also refer to an individual stock as bullish. You could even say that you are bullish on a particular market, which would mean that you expect prices to rise and you probably have bought some stock or plan to do so. So with trades that you're planning in a bull market, you intend to profit as prices rally and go higher. Your average stock market investor is generally bullish. They might have a 401k or other retirement account that holds long securities, or simply are following the old mantra of buy and hold. However, did you know that up is not the only direction in which you can take a trade? That's where the bearish side comes in. If the bears are in control, then we are in a downtrend and prices are going lower. You could refer to a market as bearish, an individual stock as bearish, or even you could be bearish, which of course means that your outlook is that prices in whatever security or market you're referring to are headed lower. The trades that you'd be looking for in a bear market have the goal of profiting as price drops, since that's what you expect. You'll learn in future lessons how to capitalize on markets in which your outlook is bearish. So now you know the terms bullish and bearish. You'll see them used throughout your education and referenced through the financial industry in general. Now when you see some hotshot on TV talking about the bulls and bears when looking at a price chart, you won't think he's losing his marbles talking about wild animals in the financial markets all in the same sentence. And as a bonus, you have a fun little piece of history for your weekly trivia night about how these terms came about. In the industry, there are two main forms of analysis: fundamental analysis and technical analysis. In this lesson, we're going to look at each one of these methods. Let's start with fundamental analysis. Fundamental analysis assesses the overall health of an economy or a specific company, and it's really looking at the longer-term perspective. From a broader standpoint, our economy is driven by factors such as retail sales, gross domestic product, interest rates, and more. These factors steer our economy for better or for worse. Sounds like marriage or something. For a specific company, fundamental analysts are looking at these economic factors as well, plus various business attributes of that company's operation. Things like their earnings, PE or price to earnings ratio, debt, profits, revenue, etc. Other attributes include the company's leadership, management style, product innovation, and pipeline. The purpose of fundamental analysis is to have a clear picture of a company's current condition, as well as long-term trends to gauge the markup potential for possible investing opportunities with the company. Many fundamental analysts are more than just individual speculators. They're engaging in financial industry activities such as managing a hedge fund with large sums of money to invest over longer periods of time. So it makes sense that if they're going to invest a lot of money into a company, they want to make sure that this company is healthy and has good probability to succeed. It's important you understand that there's a difference between trading and investing. If you're trading, you're looking for trades that last for shorter periods of time, minutes, hours, days, weeks. Whereas if you're investing, you're looking to invest in a company because you believe in that company. You believe that over time, that company is going to perform well and their markup value will continue to rise. When you're trading, your focus is not as much on future long-term performance of the company, but rather on what's going to happen in the near future. Is price going to go up or down in the relevant time period of the trade you're looking to take? For trading purposes, fundamental analysis is important, but it becomes secondary. Because even great companies that are going to succeed over time will have their down days or down weeks or even down months. So as a trader, you're more keen on spotting the short-term direction. Technical analysis, on the other hand, is the study of price movement. This movement, also referred to as price action, is analyzed by using various graphical tools such as charts, volume, trend, range, and much more. These tools are generally referred to as studies or technical indicators and oscillators. Most conventional traders prefer technical analysis over fundamental analysis. Since you're getting trained in a strategy based on supply and demand, we view the charts a little bit different. We use portions of technical analysis, such as charts, along with a few select indicators, to formulate our analysis and make decisions. Now, we recognize that conventional technical analysis provides a data-driven picture of the past, of what has already happened. But our analysis approach uniquely trains traders and investors to look beyond what conventional indicators provide and look deeper into what these figures are telling us about the future to truly time the markets with a high degree of probability. So now you have a good understanding of what both fundamental analysis and technical analysis are and how each is applied when trading and investing in the financial markets. In this lesson, we're going to explain reward to risk ratios, what they are, how you determine them, and why they're important to your trading and investing. To help with understanding, we will use the example of entering long a stock at $10 with a stop loss at $9 and a target of $13. Now that we have some numbers to work with, we can now calculate our potential reward, risk, and reward to risk ratio. The reward to risk ratio helps us determine how much risk it will take to achieve a desired return. It is derived by taking our anticipated reward, how much we hope to profit on this transaction, and dividing it by risk, how much we are willing to lose on this transaction. The reward part of the ratio is the profit made when closing the trade at your profit target, or the difference between the entry price and the target price. Since we bought at $10 and our target was $13, we would have a $3 reward per share. The risk part, on the other hand, is the loss incurred when closing the trade at the stop loss, or the difference between the entry price and the stop loss price. If we bought at $10 and were stopped out at $9, we would have a loss of $1 per share. The reward to risk ratio compares potential profits to potential losses on the trades you'll be making. As you can see here, we have defined our reward on the trade at $3 and the risk at $1. Now let's figure our reward to risk ratio. It is calculated by dividing the reward by the risk, or the amount of profit you're seeking to gain when the position is closed at the target, by the loss amount if the price closes at your stop loss. Since we defined our reward on this trade at $3 per share and are willing to risk $1 per share, our reward to risk ratio is 3-to-1. Why is this ratio so important? Remember, there's no such thing as a risk-free trade. We always know that there's a potential to lose on the trade that we're taking, and that's okay as long as you lose small. This ratio will help keep us out of trades and investments that don't offer adequate reward for the risk that we're taking. In general, we are striving for a reward to risk ratio of 3 or higher. Anything less than that just isn't really worth the risk. So, now you know what a reward to risk ratio is and why it's so important to your trading and investing. In this lesson, we're going to talk about a long position. The most common way to make money in the financial markets is by buying low and selling high. This is referred to as a long position and is simply one that is bought with the intention to sell later at a higher price. The entry is a buy order that opens the position. In this example, you can see the entry here is at 30. Then, as price hopefully rises, you sell to close the position at the target. In this trade, it was at 40. The profit made is the difference between where you sold and where you bought. So we bought at 30, sold at 40, and profited 10 points. You buy to open, allow prices to rise, and then sell to close for a profit. So now you know what a long position is. It's a valuable tool in your arsenal if you are bullish and expect prices to rise. In this lesson, we're going to explain what a short position is. We all know that in the financial markets, you can make money by buying low and selling high. But did you know you can do that in reverse order? This means there's a way to profit as markets drop by using a process called shorting. A short is simply a position that is opened by selling first with the intent to buy it back later at a lower price. In this example, we see the market has traded into a supply zone at 40, where we open our position by selling. As price drops, we will close the position when it reaches our target at 30. Similar to a long position, the profit made is the difference between where we sold and where we bought. So in this case, we sold at 40, bought at 30, and profited 10 points. For us as traders, the important thing is that we always sell at a higher retail price and buy at a lower wholesale price. Whether we sell first to open or buy first to open simply depends on the current market direction, up or down. It doesn't matter to us, we can benefit from either. But how can you sell a stock you don't own? The answer is simple. You borrow the stock from your broker. Let me explain. Let's say we have applied our supply and demand methodology and found a stock we feel is going to be heading down. We map out the trade and hit the sell short button on our trading platform. The broker's computers see that we don't actually own any of the stock to sell. Well, that's not a problem since the broker usually has plenty of buy and hold investors who do have the stock. So the broker simply loans us their stock, which we then sell in the market. Later, when we buy the stock back to close our position, it goes back into whosever account it was originally borrowed from. The broker is happy as they earned a little interest on a no-risk loan, and we are happy because we were able to profit from a market drop. The good news for us is that this all happens almost instantaneously behind the scenes. To better understand how this works in the stock market, I'm going to talk about banking for a minute. When you put your money into a savings account, what does the bank do with your money? They don't just hold it there for us, do they? No, they use it to make more money. They loan it out to other people. Now, what do you suppose a brokerage does with the stock they're holding long-term for investors in retirement accounts? Are they just holding it for them until they retire? No, they use it to make money as well. Among other things, they lend it out and earn interest from it. No wonder they want us to be buy and hold investors. Something to keep in mind, since we are borrowing the stock, our account must be approved for margin. A cash account is where you can only trade or invest the money you deposit into the account. Most retirement accounts are cash accounts, not margin accounts, so shorting is not allowed in a retirement account. A margin account is where you are offered leverage on money you deposit. So if you deposit $5,000, you could trade up to $10,000 worth of stock. Or you could even get greater leverage in asset classes like options, futures, and Forex. There are times when we would like to short a stock and the order gets rejected. There are several reasons why this can happen. Let's say that the stock you would like to short is a smaller, unknown company and not very many people are holding the stock long term. This can make the shares hard to find and borrow. We will usually have much better luck shorting the large, well-known companies that mutual funds and individuals hold for longer terms. Another reason a stock can be difficult to short can be that the broker has already loaned out all the shares that they had available and just doesn't have any left to loan. Additionally, brokers do have some restrictions placed on them following an initial public offering that can make it difficult to open shorts within the first 30 days following an IPO. If you're trading stocks, contact your broker and ask them what stocks you can and cannot short. Good news for you futures and Forex traders, however. Since those markets are structured differently than stock markets, they don't have the shorting restrictions that stocks have. So now you know what a short position is. When the markets are dropping, we can hit the sell button to open our position, wait for price to drop, and then buy back the stock later to close our position for a profit. For bear markets and dropping stock prices, this is a powerful tool in our arsenal. Before we dive into the concepts of supply and demand and market timing, you first need to take in the big picture of the markets and understand the flow of trading. In this lesson, we'll introduce you to all the market participants and explain their roles in the marketplace. All markets break down into two primary components. The first is the buyers and sellers, the people who are trading, and the second consists of the products they trade, goods and services like wheat, copper, foreign currencies, coffee, stocks, and commodities such as gold and oil. Buyers and sellers and the products they buy and sell, that's the market. Now, if you can put everything into these two baskets, then you have to ask yourself who or what is moving the market. As you'll see, all market participants are not the same. Our strategy aims to identify the imbalances between buyers and sellers, specifically caused by the major players in the marketplace. But we can't spot them if we don't know what they look like. So who are they? The market includes many different categories of investors. Mutual funds make up a large part of the market, mainly companies managing 401k plans and other generally long-term investments. Mutual funds amount to trillions of dollars in managed money and certainly have the power to move markets. Similar to mutual funds, hedge funds have rules or prospectuses that define and limit the types of investments. Unlike mutual funds, hedge funds can go short and can invest in many different asset classes, including foreign currencies and commodities like oil, corn, and soybeans. Hedge funds control a large amount of money and heavily influence the markets. Next up are small investors and day traders, participants who don't necessarily influence the market. There are market speculators, investors who base short-term trades off of probability. You also have people who make a living in the markets, like professional traders and market makers, and traders who buy and sell for institutional accounts. Those are the obvious types of traders, but you also have investors in the market that you might not have thought about or considered, including companies and businesses. That's right, some of the big companies around the world that you may know and love are actively trading in the marketplace. Take Starbucks, for example. Most people expect when they walk into their neighborhood Starbucks, the price of a cup of coffee will be the same price as it was the day before. But what if the price of coffee beans suddenly shot up overnight and your $5 cup of coffee jumped to $15 the next day? That could severely impact their earnings. So Starbucks has traders actively working in the coffee bean futures market to ensure the price of a cup of coffee stays relatively the same for you, their beloved client. Any big company relying on crucial commodities such as grains, sugar, oil, or gas is involved in trading those assets. Companies also directly invest earnings or profits in the stock market and even in other companies. Then there are the portfolio managers who fall under the mutual and hedge fund categories, and banks which invest client deposits to achieve a higher return than what they pay to their customers. Governments also get in on the action, not only investing in specific market segments, but also wielding major market influence by something as simple as signing a contract with a big company. Investment bankers look for opportunities to allocate large sums of investor money into the markets, generally by discovering new companies and bringing them public on one of the exchanges. And then there's you. As a small investor or day trader, your actions generally won't impact a market or the direction of security prices. But that's actually an advantage because the bigger you are in the markets, the more people notice you, follow your trades, and try to manipulate your actions. For the small investor, there are countless opportunities every trading day to watch what the big players do and profit from their market influence and power. Now you know the components of the market, the categories of investors, and their roles in the marketplace. We'll explore these players further in upcoming lessons and provide you with a better understanding of where those big money imbalances are and how to take advantage of them. By now, the big picture of the markets and how they work should be coming into focus for you. You know the parts and participants, and in this lesson, we'll map out another essential step in understanding the markets, the flow of trading. When we talk about market flow or the process of order execution, we're referring to how orders get to an exchange. Here's a simple visual representation of the way it's been for over a century. Back in the day, the only way for a trader to buy or sell was by sending the orders to a broker. A broker is merely an intermediary between the trader and the exchange. Their job is to send your order to the appropriate exchange in a timely and efficient manner. For this, they are paid a commission or charge you a fee. The problem with this system is how slow and cumbersome and inefficient it became. For example, let's say you're in a panic and you call your broker to sell 1,000 shares of stock XYZ quickly. You assume that your broker will immediately execute that trade and sell your stock. But in reality, your broker may be on another call, out of the office, or executing another client's trades. There are countless reasons a broker can slow down your trade and delay it from being processed at the exchange, and depending on the firm you're trading through, your order may have several other stops before it gets there. And time is money. Up until the late 1990s, only financial institutions had access to the new electronic trading systems that were starting to emerge. By the end of the decade, smaller investors had had enough of the delays and filed numerous lawsuits to gain individual access to electronic trading. The result of these lawsuits opened up trading to everyone and was the beginning of a revolution for retail investors. For the first time, you could bypass the broker and interact directly with the exchanges. That made trading not only more immediate, but also cut down or eliminated many commissions and fees. Trading technology continued to advance into the 2000s, which ushered in a system called direct access. Direct access allows clients of trading firms who employ the technology to select an order route and go directly to the exchange, bypassing intermediaries, those who might slow down a transaction. The result of removing these intermediaries means more profit potential and almost instantaneous transactions. Today's traders can choose between both a direct access broker or a traditional broker with pros and cons to each. A traditional broker may be the way to go if you're uncomfortable executing your orders or don't have the time or patience to trade. Just remember, you'll likely pay their commissions and fees. Not only that, but this broker could be trading for their firm and potentially against your order flow. For traders who want speed, efficiency, and transparency, a direct access platform is probably the better route. Now you know how market orders go from a trader to the exchange, along with a little background information about the evolution of market flow. In this lesson, we're going to explain the components that make up a chart. A chart represents a history of price movement or price action, as it's called by many traders. The horizontal x-axis represents time moving from left to right, with the most current price action for the market at the far right. The vertical y-axis represents price, with the current price highlighted on the right side of the chart in the y-axis price column. The colored vertical bars in the chart are called candlesticks. You are going to become very familiar with candlesticks later. But for now, just remember that a candlestick represents a record of all the transactions during a specified period of time in a particular market. The customizable status bar up here at the top left contains several pieces of information. First, we have the ticker symbol, which lets us know which company's price chart we are looking at. Next, we have the chart's time frame, or the amount of time each candle in the chart represents. You also see the opening price of the day, the highest price of the day, the lowest price of the day, and the closing price of the day. And finally, we see the day's volume, which has transacted in this trading session. So now you know the components of a chart. Get familiar with them and expect to see a lot more. Charts like these are key to analyzing your future trades. In this lesson, we're going to explain the components of a candlestick. A candle records 4 pieces of information: the open, the close, the high, and the low. These are 4 specific prices at which an order is filled during the time window represented by the candle. Remember, a candle usually represents a set window of trading activity, like 5 minutes, an hour, a day, a week, etc. You choose the time frame. The open is the first trade that transacted during that time window. The close is the last official trade that occurred during that time window. The high is the highest price that security reached during that time window. And you guessed it, the low is the lowest price this particular security reached during that time window. The body of a candle represents the difference between the open and close for the specified time frame. These bodies will be colored red or green to help us understand the trading activity during that candle. For example, if a candle closes higher than it opened, the body would be colored green to indicate a bullish candle. If a candle closes lower than it opened, the body would be colored red to indicate a bearish candle. A candle may also have wicks above and below the body. These wicks are our record of how high and low price went for our specified trading interval. In this example, you see a green candle, which tells you that this specific candle closed higher than it opened. But it also has a top wick and a bottom wick. This indicates that during that trading window, price dropped much lower than where the candle opened and also reached a higher price than where it ultimately closed. This gives us a greater understanding of range, or how much the security has moved in that set time period. Not all candles have to have wicks, however. As you can see here, we have a candle that opened at the high and closed at the low for that time interval. Therefore, no wicks. Same thing here for a candle that opened at the low and closed at the high. Wicks are also referred to as shadows or tails, but we like to say wicks to keep with that candlestick theme. So now you know the basic components that make up a candle: the open, the high, the low, the close, the body, and the wicks. In this lesson, we're going to talk about the life of a candlestick. If you have ever sat and watched a price chart during market hours, you'll notice that it is generally moving. A living, breathing entity diligently documenting the trades for a specified window of time. To make this picture clearer, I want you to think about a tattoo. Most see a tattoo as a work of art. It may tell a story of triumph and tribulation, or just be a regretted decision. Regardless of the reason for the tattoo, they all start out with one needle poke. By itself, it's insignificant, but when strung together with thousands of other needle pokes, the picture comes to life, a permanent record of countless little data points. Charts are exactly the same, a work of art, evolving with time, all constructed with single data points. Let's start with a tick chart. A tick chart is essentially a giant connect the dots graph. Every transaction that is made gets its own separate place on the timeline and is connected with a solid line. Here we can see a window of 5 minutes worth of trading activity and all the trades that occurred during that time. Each point on the chart representing exactly one transaction. From this, we can translate the data to create a candle or bar chart. Now let's turn this 5-minute window of transactions into a candlestick chart. To start with, we will map out the high and the low for this trading period. With these two pieces of information, we now have the range, or how much this security moved in that 5-minute period. Now we will add in the open and the close. On a bar chart, the left side of the range is the open and the right side is the close. Since we know that during this 5-minute period, price closed lower than it opened, we would paint it red. And voila, we now have a candlestick, which gives us a simple, clear representation of an entire 5-minute trading period. More specifically, this exact candle right here. Now let's look at the same exercise, but in reverse order. Here you have a daily chart of a stock. It shows you each day's trading activity during regular market hours from 9:30 a.m. to 4 p.m. Eastern Standard Time. Each of those candlesticks may represent a few transactions or thousands. Let's break down this candle right here and show how it changed during the trading day on a 5-minute basis. Here we can see that 3 candles are on the chart, telling us that we are now 15 minutes into the trading day. The first trade that happened at 9:30 a.m. is a permanent record of the open and will not change throughout the trading day. With these 3 candles, we can already create what the daily candle looks like so far. We can see that it briefly traded lower and reached a high of $29.95. Now we have a visual picture of the range as well. Finally, at this point in the trading day, the last trade that occurred is here. This will be a temporary close for now. Since it is currently trading higher than it closed, we would have a green candle that looks like this at 9:45 a.m., 15 minutes into the trading day. A little later in the day, we can see that prices have now retreated to just about where the security opened for the day. Our candle has changed completely. Notice that there is no longer a big green candle body. It is now a thin little green body, indicating that it is currently just a little above where it opened. So at 10:35 a.m., our daily candle looks like this. Then selling pressure continues. Just a few hours later at 1:05 p.m., prices are at the low of the day. Since our last trade is at the low and significantly lower than where it opened, we now have a large red candle body, which visually represents the negativity currently in this security. But the day is not done yet. The tail end of this trading day sees the bulls come in and push price back up almost to the opening price. When the closing bell rings in New York at 4 p.m., we now have a daily candle that is permanent. No more changes will be made to our daily candlestick. It ultimately ended up as a tiny red candle because it closed slightly lower than it opened, and we have long wicks or tails above and below the body indicating its range. Now you should have a clear understanding of how transaction records can be used to create candles. Remember, you determine what time frame you want to view the markets when using candles. It could be as short as 1 minute or as grand as yearly candles or any time frame in between. When you're looking at a daily chart, change it to a 60 or 15 minute to see how those daily candles are created. If you're looking at the 60-minute candles, check out the 5-minute chart to see how that 60-minute candle is created. These simple exercises will help you understand the fractal nature of prices and market movements. Each candle on a price chart tells a story, the story of a miniature battle between buyers and sellers. In this lesson, we're going to explain how to interpret a candle to determine exactly what happened during that battle. It's called candle sentiment. Your first step in gauging candle sentiment is to establish the candle's range from the high to the low. The second step is to determine where price closed in the candle. The higher price closes on a candle, the more bullish the sentiment. The lower it closes, the more bearish the sentiment. This color-coded meter helps identify candle sentiment. If price closes in the bottom 20% of the candle's range, it's considered very bearish. If it closes in the bottom 20 to 40% of the candle range, we'll call it just simply bearish. If price closes in the middle of the candle's range, between 40 and 60%, it's neutral. A bullish sentiment is when price closes between 60 and 80% of its candle range. And if it closes anywhere between 80 to 100%, it's considered very bullish. Candles come in 2 colors and all sorts of shapes and sizes. Your first instinct may be to judge a candle by its color, green for bullish or red for bearish, but that would be a big mistake. Remember, sentiment depends on where price closes within the candle's range. To help you identify candle sentiment, here are 6 different candles, each with different colors, opens, closes, highs, and lows. To help you determine which of these candles are bearish, bullish, or neutral, let's use our candle sentiment meter. Candle number 1 is a large green candle, which means that it closed at the dead high. That makes it a very bullish candle. Candle number 2 is red, and even though it has a long bottom wick, price still closes just below where it opens. And since it closes in the top 80% of the candle's range, that makes it very bullish as well. The story changes, however, with candle number 3. You can see there's a large red candle body indicating that the close is much lower than the open. Since it closes within the 20% range, that makes it very bearish. Candle number 4 is a green candle that closes in the very bottom of its trading range, around 18-ish%. So even though it's green, candle number 4 is very bearish. Candle number 5 is a little bit tricky. You see by the top and bottom wicks, it's very bearish at one point and very bullish at another. Even though this candle has a large range, it's a neutral candle because it closes right in the middle of its range. And finally, we have candle number 6. It's a little different than the others because its range isn't as large as the preceding candle, requiring us to compress our meter. And when doing so, we see that the candle actually closed at the very bottom of its range. At first glance, you may have thought it as being neutral, but after a closer look, this is a very bearish candle. Now you know about candle sentiment and how to tell if a candle is bearish, bullish, or neutral. The key is to not let the color of the candle influence your analysis. Instead, focus on where it closed with regard to its range. That is the true sentiment. With a little practice, identifying candle sentiment becomes second nature. In this lesson, we're going to explain 4 different types of candle structures, the components of each one, and what they represent. The first type is a candle with no apparent body, also referred to as a doji candle. When a candle's opening and closing prices are the same or very close to the same price, it leaves no candle body. Price may have gone up or down within that time period, leaving upper and lower wicks, but when the price closes at or very close to its opening price, there is very little or no candle body. The second type of candle is one with all body and no wicks, just the opposite, just a simple rectangle or square. This candle indicates that the open and the close are also the high and the low for the time period. In this green candle here, price opens at the bottom of the candle body, which is also the low, and it closes at the top of the candle body, which is also the high. The third type of candle has just one wick, either at the top or at the bottom. This means that, depending on the candle color, the candle opened or closed at the same price as the high or the low. So for this red candle, we opened at the top of the candle body, climbed a little higher from there, represented by that top wick, and then dropped to the low of the candle where it closed. With a green candle, we know that price opened at the bottom of the candle body. The lower wick tells us that price traded lower from the open and then reversed, trading higher all the way up to the close at the high of the candle. When the candle closes also at the high, there is no upper wick. The fourth and most common type of candlestick structure is one with 2 wicks, one at the top and one at the bottom. This indicates that the high and the low are both distinct from the open and the close. While every candle records 4 pieces of information, the open, high, low, and close, their relative location to each other, along with the candle color, tells the observant trader a story about supply and demand in the marketplace. So, now you know the different types of candle structures, what they look like, and what their various components represent. At this point, you should know the different types of candle structures and their components, the open, the high, the low, and close. So in this lesson, we'll look at how a series of candles can combine to make specific formations on the chart. These formations are the building blocks we use to perform our analysis. The 3 candle formations we'll be looking at are the rally, the drop, and the base. Let's start with the rally, which is one or more leg candles consistently going higher. A rally can be a gap up, in which case we must sort of color in the leg candle in our mind's eye, or it could be a single tall green candle, or more commonly, a series of candles that show price moving higher. Rally candles, including gaps, are generally taller candles with each candle in the series closing higher than the previous candle's close. A drop is the second type of chart formation, and it's the exact opposite of a rally. A drop can be a gap down, in which case we must color in the leg candle in our mind's eye, or it could be a single tall red candle, or more commonly, a series of red candles that show price moving lower. Drop candles are generally taller candles with each candle in the series closing lower than the previous candle's close. The third formation is a base. A base is a series of one or more base candles going sideways. A base can include both red and green candles. Base candles are generally shorter candles relative to the rally and drop candles that precede and follow these sideways moving base candles. It's important to recognize these types of candle movement in the charts. Now you know the three primary types of candle movement on the charts: the rally, the drop, and the base. In this lesson, we're going to explain the different states of an order. These three states are California, Florida, no, I'm just kidding. These three states are sent, executed or filled, and unfilled. Once a trader places an order through their trading platform, the order is sent to one of the exchanges to await execution. For example, say that you wanted to buy 100 shares of Microsoft at $110 a share. The instant you place the order, it is sent to the exchange. If there is a seller at the exchange willing to sell their shares at that price, the order will immediately execute or be filled. These two terms, executed and filled, are used to identify partially or fully completed transactions in the market. Candlesticks on the chart are visual representations showing us these executed or filled orders. Now, what happens if our order reaches the exchange and there isn't a seller willing to sell at our price? In that case, the order is unfilled and so gets placed into the order book at the exchange where it awaits for execution. It is large, unfilled institutional orders in the market that turn price. However, recognizing these locations isn't apparent to an untrained eye. Learning to extract this information from price charts is a key to our success as a trader and will be the focus of much of your education. This process will become clearer as you learn and understand the forces of supply and demand and their effect on price. So, now you know the different states of an order: sent, executed or filled, and unfilled. This strategy is all about supply and demand. We use the charts to decide at what point we're going to engage the markets. That makes it crucial to understand what those charts represent and how to read them. In this lesson, we're going to explain the importance of two of the key parts of those charts: filled and unfilled orders. Charts represent filled orders in a market. The classic definition of a chart is that it represents price movement through time, since the vertical axis measures price and the horizontal axis corresponds to time. That's a good definition, but it doesn't explain how price actually moves through time. And that's where filled and unfilled orders come in. So we tweaked the definition to say that charts represent filled orders through time. By now you know that a chart is made up of candles and that a single candle represents a unit of time and all the transactions recorded within that time period. In other words, all the prices at which orders were filled during that time period. But filled orders have already happened. They're in the past. As supply and demand traders, what we want to know is, what is price going to do next? To do that, we need to find those stacks of unfilled orders. Here's a 60-minute chart of SPY. Each of these candles represents all the transactions, all the orders that were filled, and the prices they were filled at during 60 minutes of trading time. To make money in the markets, you buy low and sell high by anticipating market moves consistently. When you know where those unfilled orders are, specifically the ones from big institutions, you unlock the ability to time the markets. But to find those unfilled orders, you have to be able to read the charts differently. And that's where our strategy comes in. So now you know that although the charts represent filled orders, it's finding those unfilled orders that are key to your success as a supply and demand trader. Once you learn how to spot those unfilled orders by analyzing candles and understand why those orders are important, you'll be able to turn that knowledge into the skill of timing the markets. In this lesson, we're going to identify the 4 different types of orders and introduce some fundamental terms and tools you need to know in order to understand the way orders work. There are 4 basic order types: a market order, a limit order, a stop market order, and a stop limit order. We'll focus on each order type in upcoming lessons, but first, let's go over some of the mechanics of how orders work. There are 3 key terms you need to know. First is the bid, which represents willing buyers in the marketplace. The buy orders in the order book are all limit buy orders, which is an order to buy at a specific price. The current bid is the current highest price among the buy orders. The second term is the ask, often called the offer. This is the price that represents sellers in the marketplace. The sellers in the ask column are using limit orders, which is an order to sell at a specific price. The current ask is the lowest price among the sell orders. And finally, we have the spread. The spread is simply the difference between the bid and the ask. To help make these 3 concepts clearer, here's an example. This is known as level 2 data, or the market depth. It's data that groups limit orders by price. The bid side of the grid, located on the left, represents limit orders for investors willing to buy. The ask side of the grid, over here on the right, represents people lining up to sell with limit orders at specific prices. The top row of the bid side, called the inside bid, shows a bid of 30.26, which means somebody has a buy order to purchase shares at that price. These are considered passive buy orders since they're willing to wait for a specific price. In the next column, you see size, which indicates that order is for 100 shares at that price of 30.26. Right below, on the next line, there's someone else who is willing to pay a penny less, 30.25, and they want 50 shares. The highest price that someone is willing to pay with a limit order will always be at the top of the grid. On the ask side, the top level is called the inside ask and represents sellers passively waiting for their price. This is also the lowest price that anyone out there is willing to sell their shares at. We see 4 offers to sell shares at 30.42. In the size column, there are various quantities available at that price: 100, 11, 300, and 100 shares. Underneath that, 2 people are willing to sell 100 shares each for 1 penny more at 30.43, and so on and so forth down the list. The difference between the inside bid and the ask is the spread. With the bid at 30.26 and the ask at 30.42, the spread is 16 cents on this specific security. In current markets, spreads are usually between 1 and 2 cents. A 16-cent spread is quite wide and would be a red flag for risk. As a little review on order states, execution is when an order meets its entry price and the trade becomes live in the market. Another way to say that is the order has been filled. When you receive the shares or bought, or if you're selling once all your shares are sold, that order is filled. Depending on the security you're trading, slippage may occur. Slippage is simply the difference between the quoted price at the time the order is sent and the price when the trade executes. It means you didn't get the price you wanted. This happens to securities that are thinly traded and don't have a lot of volume. Now you're familiar with some basic order terminology and principles. Next up, we'll dive deeper into each type of order. In this lesson, let's talk about market orders. Have you ever gone to a fish market and next to the typically expensive types of fish, it just has the word market? What does that mean? It means you're paying whatever price it's going for on that day at that moment. A market order is kind of like that. It's the trader saying, I don't care what price I get my lobster, but I want it right now. A market order is an aggressive order to get filled at the best price it can at the moment it gets sent. So it's used when there's an urgency to get filled by investors looking to exit or enter a position immediately. That's the plus side to a market order. When it's sent using a direct access trading platform, it gets filled immediately, within fractions of a second. Submitting it through an online brokerage firm may take a little longer, but it's still the fastest execution available. Now, if you want to get filled immediately, you can't choose the price at which you're going to get filled. So that's the drawback. Because the order doesn't negotiate with the market, it can incur slippage, which is the difference between the quoted price at the time the order is sent and the price when the trade executes. This means when you use a market order, you may not get the best price. Think of market orders as price-seeking missiles. For example, let's say we want to buy 500 shares. That means we need a seller to buy from. So with a market order, when we hit the buy button, our order immediately shoots off to the ask column where the sellers are lining up to sell. Let's see where we'd get filled on this specific order. Since we want 500 shares, notice how many are available on the inside ask at 30.42. There are 100 shares, 11 shares, 300 shares, and 100 shares. Since there are enough shares available to cover our order size, that means we should get all 500 shares filled at 30.42. If there aren't enough shares available at that level, our market order would continue to the next lowest seller in the list at a higher price, which in turn would incur slippage. If you want to sell, you do the same thing. Let's say we're going for 500 shares, but now, since we want to sell, we need a buyer to sell to. The willing buyers are lined up on the bid. When we hit the sell button, we get 100 shares at 30.26, 50 shares at 30.25, 100 shares at 30.23, 100 at 30.22, and the next 100 at 30.20. The remaining 50 shares fill at 30.19. With a thinly traded stock like this one, a market order has the ability to move prices, and we could incur a significant amount of slippage in the process. In this case, 7 cents from 30.26 down to 30.19. Now you know what a market order is, how it works, and when it's used. To recap, it's used for immediacy of execution, not for fills at specific prices. Because of that, it can incur slippage, so best to stay away from thinly traded securities. In this lesson, let's talk about the limit order. If a market order says, get me filled now at whatever price, a limit order says, only get me filled at this price or better. It has a specific price attached to it. A limit order is considered a passive order because it waits to be filled until a specific price is met. For this reason, it's used by investors and traders to specifically plan their entries and exits. The good thing about a limit order is that you won't incur slippage, and you may even get a better price than expected. This doesn't happen often, but it can. The not so good thing about a limit order is that it may only get partially filled or may not get filled at all. You can't have your cake and eat it too. If you want to get a specific price, then you can't guarantee you'll get filled. In this example, we set the limit price at $30.26 to buy 500 shares. When we click the buy button, it's unlikely that the order will be filled immediately because the lowest willing seller in the ask column is at $30.42, and we only want to pay $30.26. Since the sellers are unlikely to drop their price 16 cents just to sell to us, we line up at the bid with other traders waiting to buy at $30.26. If and when sellers show up at lower prices down to $30.26, then our order will most likely be filled. Let's say you want to sell instead, setting the limit order at $30.42 and the quantity is still 500. Using a limit order, the system knows to limit the fill price to $30.42 or better. You won't get anything less. As you can see, the most that anyone is willing to pay right now is $30.26 at the inside bid. When we hit the sell button, our order will not get filled immediately and will become a passive order waiting to sell in the queue on the ask side at $30.42. You're not guaranteed to get filled, but if you get filled, it will only be at $30.42 or higher. Let's take a quick quiz. Looking at this book of orders, let's say that you wanted to buy right now at the best available current price. What type of order would you use? It's almost given away in the question. If you're buying at the lowest available market price, then this would be a market order. What if you wanted to join the bid with the other hopeful buyers at, say, $10.82? What order type would this be? If you said limit, you would be correct. Remember, since you're specifying a price, it would be a limit order. On the sell side, if you wanted to sell right now at the best price available, what order type would that be? That's right, a market order. To sell, you need a buyer to sell to. So in this picture, a market sell order would be selling to the highest bidder, starting at $10.83. If you wanted to sell for no less than $10.85, what order type would that be? It has to be a limit order since you are specifying a particular price. You'd join the other sellers in the ask column. Now you know what a limit order is, how it works, and when it's used. To recap, a limit order is used for specifically planned entries and exits. Unlike market orders, there is no slippage with limit orders. Although orders may be only partially filled, you'll only get filled at the price you want or better. As we've emphasized over these lessons, risk management is a significant factor to your success as a trader. In this lesson, we'll explain the stop market order, a key tool to protect you from big losses. Essentially, a stop market order is a conditional order, which means it is only sent as an active order if a specific condition has been met. It asks the simple question, did price hit the specified stop number? If it did not, then don't do anything. If it did, then close the trade out. It's that simple. With any stop order, stop market or stop limit, the order is triggered at a specific price known as the stop price. Once the order is triggered, then it'll send the order. In the case of a stop market order, it'll send a market order once the stop price is triggered. If a stop limit order, then it would send a limit order. Though we don't want to use the words always and never with the financial markets, we can say fairly confidently that you will always use a stop market order as a stop loss to exit a trade. See, a market order doesn't guarantee a price like a limit order does, but it does guarantee to get filled. If the trade is going against you, you want to make sure that you get out and cut your losses short. If you use a stop limit order, you're chancing that price gets to your stop loss price, but blows right through and doesn't fill. And now you're in a bad losing trade. You don't want that to happen. So to avoid that and practice good risk management, you use a stop market order as a stop loss to guarantee your exit in the trade and protect yourself from large losses. Because it's ultimately a market order, you could suffer slippage. However, since that market order is sent at the moment that current price is at your stop price, in high volume markets, you shouldn't experience slippage too often. As an example, let's say we enter long at 34.30 at this demand zone and want to make sure we get out at 34.15 to protect the position. Every trade is different, but in this setup, the trade risk is 15 cents per share. So how do we protect ourselves? In the order entry panel, select Stop Market under order type. Then you put in the price you want to trigger the stop loss in the stop field. If price hits that number, a market order will be sent to get us out of the trade. Think of it as an if-then situation. If price hits 34.15, then a market order is sent. Since we're going long, our exit is a sell order, so we hit the sell button. Now we've protected this trade from significant loss. On the other side, if we open a short position at 34.30 and decide to place the stop loss at 34.45, we're looking at a 15-cent loss per share. In the order bar, select Stop Market under order type and enter the stop price 34.45 in the stop field. Since we're short, the exit is a buy to cover order. Once the order is sent to the market, we're now protected from taking a large loss. Because it ends up being sent as a market order, there's a chance of slippage. And if it's a fast-moving security or has a gap, we could lose more than 15 cents. But the important thing is there's a mechanism in place to prevent us from taking a significant loss. Now you know what a stop market order is and how it's used as a risk management tool to protect you from large losses. Your account can't sustain large losses. If the trade is going against you, cut your losses short and get out. Stop markets are the order to do that and avoid those big losers. In this lesson, we're going to introduce the stop limit order. A stop limit is similar to a stop market. It asks the question, has the stop price been hit? If not, then nothing happens. If it has been hit, the system will send the order, but this time it'll send a limit order. Though this may limit slippage, we'll show you how this increases risk if it were used as a stop loss order. A stop limit order is triggered at a specific price, the stop price. Once it's triggered, a limit order is sent. A stop limit order is more complex than other types of orders. For one, it's more difficult to put into the platform, and secondly, it's the least likely to get filled, which means if used for a stop loss, it would carry some risk. For these reasons, it's typically only used by more experienced traders for a fancy type of entry. Since sent as a limit order, you may get filled at a better price, but you may not get filled at all, which makes it dangerous to use as a protective stop. For stop losses, your best bet is always a stop market order. I think we've already stated this about 5 times in the lesson so far, but that's how important risk management is. To explain using this chart, let's assume that the trader is long and wants to use a stop limit to protect their trade. On the order bar, they first put in the trigger price, aka the stop price, at 112.31. Next, you put in the limit price of 109.50 so that the system knows the price for the limit order that's to be sent. Think this trader is safe? Look what happened the next day. The stock gapped down beyond both the stop and limit prices. What would happen here? Well, since the price is below the stop price of 112.31, this triggers the limit sell order at 109.50 to be sent. The limit order says not to sell for less than 109.50, but price jumped to below $90. So we would still have the position open, but now in a much bigger loss. Moral of the story, don't use stop limits for stop losses. And a PS, be aware of holding trades overnight in markets that are likely to gap quite a bit. So what should a stop limit order be used for? Once you know what you're doing, you can use it as a confirmation entry. You recall the three types of entries: the proximal entry, zone entry, and confirmation entry. Let's look at a number 3 entry with a stop limit order. Price has retraced into demand. Using a confirmation entry, once price is below the proximal line at 34.30, we can send the stop limit order. The stop limit sets 2 prices. The first is the stop price. That's the price we ideally want to pay, in this case $34.31. The second is the limit price, the highest price we're willing to pay, in this case $34.33. This allows for 2 cents of wiggle room. Once we submit the stop limit order, if price moves up to $34.31 and confirms that it's leaving the demand zone, a limit order is sent, telling the market that we're willing to buy the security at no more than $34.33. That's how to use a stop limit order as an entry tool. Again, the operative words there are entry tool, not recommended for an exit order. As an example, when going short, we see price has rallied into supply at $34.34. We'll use a stop limit order as a confirmation entry. The stop price is set to $34.33. If price moves down to this price, it'll trigger the limit order to be sent. Since the limit price is at $34.31, this tells the system to fill the order at $34.31 or higher. Since this order is triggered when price touches $34.33, it's most likely it'll get filled between $34.33 and $34.31, just a 2-cent window. You'll notice that you're giving up a little on the entry and consequently on the reward as well. The idea with a confirmation entry is that you're waiting for price to confirm it's turning at the zone, but for that, you give up a little reward to risk. Now you know what a stop limit order is, why you should never use it as a stop loss, and how, with a little more experience, you can use it as a confirmation entry for your trades. In this lesson, we're going to summarize the different order types and talk about the strengths and weaknesses of each. First, let's recap stop orders. In the top left, you see a simple entry to go long at $34.30, with a stop market order placed just below the demand zone at $34.15. In the upper right-hand corner, we have a short entry with a sell limit at $34.30 and a buy to cover stop loss at $34.45. For stop limit orders, we won't be using them as a stop loss, but rather as a confirmation entry. In the bottom left-hand corner, price came into the demand zone. So we set up our stop trigger at $34.31 as price comes out of the demand zone with a limit price of $34.33. This tells the system that we want to send an order once price hits $34.31, but we don't want to pay more than $34.33. For a short entry, price came up to our supply zone, and once it leaves, that's where we want to go short. So for this, we set up our stop price at $34.33, 1 penny below the proximal line, and a limit of $34.31. Now let's review some basic orders for buying. The first step is to identify where current price is. Here, it's $40. If we are looking to buy at the current price or higher, we could use a market order, a buy stop limit order, or a buy stop market order. If you're looking to buy below current price, you would be using a limit order. When entering long, the exit is a sell order. So to protect your trade, you would place a sell stop market order below current price to exit for a small loss. And for the profit target on a long trade, you'd be using a sell limit order at a higher price than the current. Check out this example of a demand zone in an uptrend. To map out our trade, our entry will be a buy limit order at 48.26 below current price. For the stop loss, we have a sell stop market order at 48.18 below current price, and our profit target would be a sell limit order above current price at 48.97. Let's see how this played out. Price fell to the demand zone, triggering the buy limit order at 48.26, and then it proceeded to rally up to hit the profit target at 48.97, where it sold to close the position. Now let's look at shorting. First, identify current price. In this example, it's at $40. If you're looking to short below current price, you could use a sell market order, a sell stop limit order, or a sell stop market order. If you're looking to sell above current price, you use a sell limit order. For the stop loss, to protect the position, you use a buy stop market order above current price. If the trade moves in your favor, you look to exit for a profit using a buy limit order. As an example, we have a supply zone between 60.60 and 60.93. We'll use a sell limit above current price at the proximal line of 60.60. Next, should this trade not work out, for the stop loss, we use a buy stop market order above the supply zone at 60.93. And finally, we set a profit target using a buy limit below current price at 57.85. We see price rallies back to the supply zone, entering a short position at 60.60. Price begins to drop and ultimately falls to the profit target. So when do we use these order types? A market order is used for entering and exiting a position immediately. The good thing about this is that you'll be filled immediately. The negative side is you may suffer slippage. Limit orders are used to specifically plan entries and exits. The good thing about limit orders is you won't suffer any slippage, and you may even get price improvement. The downside here is you may only get a partial fill or may not get filled at all. The stop market order is used primarily to exit a trade for a loss, though it could be used for an entry as well. The positive side of the stop market order is that you are going to get out of your trade should it go against you. The bad news is you may suffer slippage because it utilizes market orders. And finally, the stop limit order. Though this could be used as a stop loss, we recommend only using it for confirmation or breakout entries. To re-emphasize, you can see we strongly recommend not using it as a protective stop, as there is no guarantee that you will get filled. Since it uses a limit order, the positive side is you may be filled at a better price. So there you have it, all the order types wrapped up. In this lesson, we're going to look at exactly how and why price moves based on order flow. Many people think that market-related influences are the reason prices go up or down in the markets. Things like earnings reports, news, company fundamentals, Fed announcements, terrorist attacks, the list goes on and on. Now, without a doubt, events and announcements like these can influence price. But that's because they influence the thoughts and perceptions of the people who are doing the trading and investing. They get scared, they get excited, they get greedy. But it's the buying and selling that is causing prices to move, and that's the picture we see on the charts. Each candle on the chart is created because of an ongoing demand and supply relationship. This flow of buy orders and sell orders is driven by demand and supply based on people's perceptions and thoughts of these potentially influencing factors. For example, let's say we have ABC stock and the stock is trading at $41.30. At that price, say we have 4 willing buyers, each willing to buy 100 shares, and 2 sellers willing to sell 50 shares. The 2 willing sellers will sell to the first buyer, leaving 3 buyers still willing to buy 100 shares each. But now the number of willing sellers drops to 0. That doesn't stop the markets, however. Buyers still buy from sellers, sellers still sell to buyers, and the transactions keep rolling along. So the adjustment for that is price. Since there are no more people willing to sell ABC at $41.30, do you think it's more likely that other sellers who hold the stock will be willing to sell at $41.20 or $41.10? Of course not. Stockholders don't jump up and down to sell their holdings for less, but we might find people willing to sell it at a higher price. So the market reaction to willing sellers of a stock going to 0 is that price goes up. The price can only go up when the willing sellers go to 0 and there's no more. If there was still one more willing seller at $41.30, the price would remain the same. It's only at that moment when the willing sellers go to 0 that price will go up. Indirectly, a lot of willing buyers can make the price rise by exhausting the sellers and causing the sellers to go to 0. But the direct reason for the rally in price is the fact that there were no more willing sellers at $41.30. Now, if we knew who the willing buyers and sellers were, we would know which direction the price was going to go. But we don't. We're missing that information. What we do have are the charts. We have to take the information that we already have and interpret this rally in price by working it backwards. If we see this big rally in price, we know it could only happen when all the sellers went to 0 at the bottom of that rally, at the origin. And if all the sellers went to 0, then it must mean that not all the buyers had their orders filled, leaving behind unfilled buy orders. Now you start to see the importance of unfilled orders. When we have a lot of willing buyers or demand and not that many willing sellers or a lack of supply, that's when prices go higher. The key factor to that price movement is the big imbalance between supply and demand. The origin of the change in price is when there are either no buyers or no sellers at a specific price. This is how price moves at its most basic level, and understanding this is fundamental to our strategy. But that's not all. When we look at the charts, we look at the whole chart, not just a single candle. We want to get the full picture of what's going on with these unfilled orders and how we can turn that into action. Now that you know why market prices change when supply and demand are out of balance, we're going to add another perspective to analyzing market prices. Supply and demand is one of the 2 most important components in trading. Human emotion is the other. Let's take a closer look at both. With supply and demand, market prices turn higher at a price point where demand exceeds supply, not at a support level. And the flip side of that is price turning lower where supply exceeds demand, not at resistance. But the other important component is understanding who is on the other side of your trade. Is it a professional or a novice trader? Now, of course, we can't actually see the other person who we're transacting with. I always think that'd be a fun dating service, but that's not how it works. However, with some training, you'll be able to spot fear and greed registering on the charts. That's because novices base their trades on emotions, so you're able to read what they're thinking based on chart movements. Let's take a look at this visually. First, where do market prices turn? The origin of any move in price is where supply and demand are out of balance. So we have a supply zone here. We know it's a supply zone because we can see price decline here. But ask yourself, why did price decline? Up here at this supply zone, price was going back and forth, back and forth. You had buyers and sellers buying from and selling to one another and so on. As long as price stays there, it means there were both buyers and sellers in the vicinity. But then price drops out of the supply zone, and we know that price can only drop when there are no more willing buyers. There had to be more sellers than buyers at this point, leaving behind unfilled sell orders. That's what we refer to as supply. Now down here we have demand. How do we know it's demand? Why did price rise? Well, price can only rise when we run out of every last willing seller, when there are no more sell orders left. So the fact that prices rose tells us that there must have been no more willing sellers at the origin of that price movement, at the bottom of that rally. That's where we ran out of willing sellers. And if we ran out of willing sellers, not all the buyers got their orders filled, leaving behind unfilled buy orders. And that stack of unfilled buy orders is what we refer to as demand. So now we know we have a big stack of unfilled sell orders up here at supply and a big stack of unfilled buy orders down here at demand. And notice what happens as price comes back to this price level, where we know we have a lot of unfilled sell orders at these prices. Price starts to reverse direction. Because we have so many unfilled sell orders and the buy orders are exhausted, there are no more willing buyers and price drops. That's what we see here. Now, when price comes down into our demand zone, we know we have a big stack of unfilled buy orders. And so when price comes back to this point, there are so many unfilled buy orders that they exhaust the sell orders, and once there are no more willing sellers left, price will rise. So we see prices rise here once more because we have so many unfilled buy orders, and they're able to exhaust the sell side and push price higher. So the second component of this is who is on the other side of your trade. So if we look at price coming back here, we see these green candles going higher. Think who would be buying at the top of these green candles? We know that there are unfilled institutional sell orders here at the top. So who would be buying here? Well, it's the novice. They're only looking at those green candles and thinking to themselves, look, prices are going up. I got to get in on this. FOMO sets in. They don't want to miss out on this going higher. When in reality, it's already gone up and it's gone into a supply zone. So then as price reverses out of this supply zone, who's panicked down here at the bottom? Well, the person that bought here at the top. Now they're panicked and they keep hoping, crossing their fingers that price will go higher. But eventually, once their pain exceeds their ego and their hope, they get out of the trade, but at the wrong time, right when it's in a demand area and prices go higher. This is not the kind of trading that we want to do. We need to think like a pro. Now you know the basics of reading a chart. Why prices go up when demand exceeds supply, why they go down when supply exceeds demand, how novice traders look on a price chart, and how unfilled orders can be responsible for the turns. The two key components when viewing the markets are supply and demand and human emotion. While institutions and professionals drive supply and demand, novice traders are driven by human emotions like fear and greed. In this lesson, we're going to look at two key mistakes novices make. The novice trader generally makes two key buying mistakes. The first one is buying after a rally in price. They see the prices going up without them and getting higher with each candle, so they just jump in and buy before they miss out on any more money. This fear of missing out is emotion driving the buy, and emotional trading decisions will almost always be the wrong decision. The second key buying mistake novice traders make is they buy in supply zones. What is it that we should be doing in supply? Exactly. We should be a seller in supply, not a buyer. It is important to always check your buy order and make sure that you're not making the novice mistake of buying in supply. And keep in mind, it is very common for two or more supply zones to be stacked on top of each other. We see novice traders make this buying mistake most often when setting a buy order to close their position. They forget to check and make sure their buy order isn't being placed in another supply zone just above the one they are trading. The professional understands these two emotion-driven buying mistakes that novices make and profit from. Now, if we flip this upside down and we have the same thing for the sell side, the novice trader generally makes the two key selling mistakes. The first one is they sell after a decline in price. Fear of losing is a powerful motivator and drives many novice trading decisions that professionals capitalize on. The second key selling mistake that novices make is they sell in demand. What is it that we should be doing in demand? That's right, we should be buying in demand, not selling. It is important to always check your sell order and make sure that you're not making the novice mistake of selling in a demand zone. Remember, a demand zone is where there is a higher probability of prices going higher. As you can see, the novice responds to the two key components of trading, supply and demand and human emotion, differently from the professional. Avoid these two amateur mistakes and instead join with the professionals. By now you know that price moves because of the imbalance in supply and demand. In this lesson, we're going to show you how to identify areas of market balance and imbalance on a price chart. Let's take a look at a balanced market first. Think about a balance scale. When you put two different items of similar weight on either side, the scale balances. Markets work the same way with supply and demand. When sellers and buyers are relatively equal, price remains relatively steady and holds within a defined range over a period of time. A balanced market means orders are getting filled. Buyers are buying from sellers and sellers are selling to buyers. Remove weight from one side of a balance scale and you'll see an immediate reaction. That's what happens in the markets too. Once one side is completely gone, when there are no more willing buyers or no more willing sellers, there's a change in price, which reflects an imbalance. A demand imbalance is when balance tips to the buyer's side and there are more willing buyers than sellers. It results in an increase in price relative to a previous high. When there are no more sellers, there's an explosive rally in price. An explosive rally is a rise in price that crosses or breaks a previous high and results in a higher high. Let's take a closer look at an explosive rally. On a price chart, you see these large green expanded range leg candles moving up in price out of an area of market balance. We'll tell you more about leg candles in an upcoming lesson, but you can clearly see these green candles setting consecutive new highs after breaking out of the balanced range. Here's what an explosive rally doesn't look like. While there's a big green candle rising from a balanced market, it fails to make a new high. This indicates that although buyers are stepping to the front, there aren't enough to win the battle and break beyond this previous high. An imbalance of supply is when the balance tips to the seller's side, when there are more willing sellers than buyers, resulting in a decrease in price relative to a previous low. When there are no more buyers, there's an explosive drop in price. An explosive drop is a drop in price that crosses or breaks a previous low and results in a lower low. Let's take a closer look at an explosive drop. On a price chart, you see this series of red expanded range leg candles moving down in price out of an area of market balance. These red candles set consecutive new lows after breaking out of the balanced range, signifying that sellers are in control. So here's what an explosive drop doesn't look like. While there's a big red candle dropping out of a balanced market, it fails to set a new low. This indicates there are just not enough sellers to push beyond this area of demand and make a new low. Understanding what supply and demand balances and imbalances look like will help you when it comes to mapping out your trades. They give us hints as to why price moved the way they did. It's one more tool we can use to help increase the probability of being on the right side of the trade. In this lesson, we're going to look at the difference between base and leg candles and how they signify periods of balance and imbalance on a price chart. Candles give us the immediate result of the balance and balance supply and demand equation, an equation where each candle tells a story. Let's start with the base candles. When supply and demand in a market are balanced, prices go sideways. That sideways movement is represented on a chart by base candles. These clusters of candles are neutral in appearance and tend to close inside the range of preceding candles. When we see basing on a chart, it means that institutions are looking to accumulate or distribute orders. Leg candles, on the other hand, represent an imbalance in the market, when the balance scale of the supply and demand tips to one side or the other, and either buyers or sellers go to zero. Leg candles are bullish or bearish in appearance and tend to close outside the range of preceding candles. It's at the origin of those imbalances, the leg candles, that we find those big stacks of unfilled institutional orders, crucial to our strategy. Now you know what leg and base candles signify and what they look like on a price chart. We'll keep these differences between base and leg candles in mind as we analyze the charts, since what we're ultimately looking to spot are those areas of imbalance between supply and demand. In this lesson, we're going to explain what a gap candle is, what it looks like on a price chart, and how it can be considered a leg candle. A gap occurs when a candle opens at a different price than where the previous candle closed. This leaves a vertical blank space between candles on the chart. As you can see here, this security closed the trading day at $32, then opened the next day at $26. That left a $6 gap down in price. I'd say that's a significant supply and demand imbalance, wouldn't you? Notice these breaks in the candles left behind where the gap occurred. To help visualize the movement of price in the gap, we need to color in the space between the close of the prior candle and the close of the candle that gapped. By visually filling in the blank space, we're able to see how these gaps could represent a significant move in price. Since they can represent a large market imbalance, gap candles can be used as leg candles. So now you know what a gap candle is, how to identify a gap on a price chart, and how gap candles can be used as leg candles. We'll go into more detail on specific types of gaps and how to analyze them in a future lesson. You've learned what candles are and how they can string together to form a rally, a drop, or a base. In this lesson, we're going to show you how combinations of these basic building blocks create our two formations of demand and our two formations of supply. We're going to begin to train our eyes to spot these pictures in the charts because, as we've learned, this is where our potential big stacks of unfilled institutional orders are waiting. Let's start by looking at our two pictures of demand. The first is the drop base rally, often shortened to DBR. Many times this formation is also called a swing low, a pivot low, or just a low. No matter what it is called, you know now it is a formation that represents one of our pictures of demand in the charts. Remember, anytime price rises quickly or rallies from an area of sideways basing trading, it leaves behind unfilled buy orders back at the origin of the rally. Our second picture of demand is a rally-based rally, or RBR. As you look at these two pictures of demand, can you recognize the common formation they share? If you see the base and rally out of the base in both, congratulations! It is this strong move or rally out of the base that leaves behind unfilled buy orders, defining this as a demand formation. When looking for demand, we find these tall green candles in the chart and simply follow them back down to the origin of the strong rally, and that is where we will always find our unfilled buy orders that create demand. Now that we have found a demand zone, what is the action we are going to take? We know we want to be a buyer in demand, but we also know we don't want to make the amateur mistake of chasing price. So the action we are going to take is to patiently wait for price to pull back into our demand zone where we will be a buyer. This pullback is also often called a retracement into demand or going on sale, kind of like Walmart rolling back the prices. We like to buy when the price rolls back, retraces, or pulls back into a demand zone. Now let's look at the picture of our two supply formations, which are the exact inverse of our demand formations. The first formation is a rally base drop, or RBD. This formation is also often called a swing high or pivot high or just a high. Again, no matter the terminology used, you know it describes a picture of supply in the charts. Anytime price drops away quickly from an area of sideways basing trading, it leaves behind unfilled sell orders back at the origin of the drop, at the top of the drop. Our second picture of supply is a drop base drop, or DBD. Again, as you look at these two pictures of supply, do you recognize the common formation they share? If you see the base and drop in both, good job. It is this strong move or drop out of the sideways moving base candles that leave behind our unfilled sell orders. When looking for supply, we find these tall red candles in the chart and simply follow them back up to the origin of the strong drop, and that is where we will always find our unfilled sell orders that create supply. Now that we have found a supply zone, what is the action we're going to take? We know we want to be a seller in supply, but we also know we don't want to make the amateur mistake of chasing price as it's going down. So the action we are going to take is to patiently wait for price to pull back up into our supply zone where we will be a seller. This pullback is called a retracement into that supply zone. We like to sell when price gets expensive up in retail areas of supply. In summary, there are two formations that show supply and two formations that show demand. Supply zones are formed when price drops away from one or more basing candles, and demand zones are formed when price rallies up from one or more base candles. By now, you should be gaining a greater understanding of what the picture of supply and demand looks like on the charts and the action to take. If it's not clear yet, that's okay. Like school, we will build on each grade level, and we're still in the early grades. Things will become clearer with each new lesson. In this lesson, we're going to talk more about zone formation and use what we have learned about base and leg candles to identify the three elements that make up a zone. Moving left to right on a price chart, supply and demand zones consist of three elements: a leg in, followed by a base, followed by a leg out. The leg in candle is always the leg candle immediately prior to the base and can be part of a rally or a drop. Here's an example of a rally leg in into a base, and we can also have a drop leg into a base. Our base is the sideways trading found in between the leg in and the leg out candles, and is composed of one or more base candles. This sideways basing area is the zone where unfilled orders are left behind when the price leaves the area. The leg out candle is always the leg candle immediately following the base and is usually in the form of an explosive move up or down. The leg out is significant because it determines the type of zone that is left behind. If the leg out is a rally, it will leave behind a demand zone, meaning the unfilled orders in the base are unfilled buy orders. If the leg out is a drop, on the other hand, then it will leave behind a supply zone, meaning the unfilled orders in the base are unfilled sell orders. Here's an example of a base followed by a rally leg out, and we can also have a base with a drop leg out. Let's take a look at an example. Here we have the leg in, which in this case is a red drop candle. Then we see our base form. As the drop stops and the market starts trading sideways for a few candles, the base is followed by the direction change again with a green leg out rally candle. Since the leg out is a rally, we know that this is a demand zone and can mark it off with distal and proximal lines. Here's another example on the supply side. Here we have the leg in, which in this case is a green rally candle. Then we see our base form as the rally stops and the market starts trading sideways for a few candles. And the base is followed by a direction change again with a red leg out drop candle. Since the leg out is a drop, we know that this is a supply zone and can mark it off with proximal and distal lines. So now you know how to identify the three elements of a zone: the leg in, the base, and the leg out. In this lesson, we're going to take a quick view of our four basic formations. What you'll notice among the four formation is the change between the leg in and base, or from the base to the leg out. It's a shift in direction. In other words, the base is a moment of sideways action in between leg candles that represent bullish or bearish movement. Let's begin with the rally base drop, a classic reversal formation. With the rally base drop, we have a strong leg-in candle followed by one or several base candles. These base candles are generally narrow in range and alternate colors between red and green. To cap off this formation, there is a sharp leg candle out. The rally base drop begins to tell the story of unfilled orders at that level. Our next reversal pattern is the drop base rally. It begins with a large red leg-in candle, followed by one or more basing candles. The formation is defined when the leg out candle is formed, generally in the form of a large green candle or a gap up out of the base. This tells us that there were enough unfilled orders to stop price from falling and force it back up out of the zone. Those are two basic reversal formations. Now let's look at continuation patterns. The bearish continuation pattern is called the drop base drop. This pattern begins with a strong red leg-in candle, followed by a base that is comprised of one or more base candles, and ultimately a strong leg-out candle in red. This formation tells us that while price was in a strong decline and buyers temporarily stopped it from falling at the base, the sellers were too strong and continued to push price to new lows. What's left are unfilled orders at the base, which we will use to our advantage next time price retraces back to that base. And finally, our bullish continuation formation, the rally base rally. This begins with a strong green leg-in candle, followed by one or more small candles comprising the base. To cap it off, we see a strong leg out, either as a green candle or possibly even a gap up out of the base. This tells us that while price was very strong and the sellers slowed it down, represented by the sideways base, the buyers persisted and pushed it into new highs. This leaves us with unfilled buy orders at the base. These four basic formations are all comprised of leg candles and base candles. As you progress, you'll be spending a lot of time looking for and identifying these formations, as they represent the best trading opportunities. They present to us the clearest picture visually of imbalances in the marketplace. By now, you've probably noticed the two horizontal lines that define a supply or demand zone. Those are the proximal and distal lines, and in this lesson, we'll explain the difference between the two and how to identify them in supply and demand zones. It's pretty simple. Always start with where current price is. The line farthest from current price is the distal line, and the line closest to current price is the proximal line. It's even easier to remember if you think of the distal line as being distant from current price and the proximal line as being closest in proximity to price. Since we want to sell at supply above current price, the proximal line in a supply zone will always be the lower line closest to price, and the distal will always be the upper line. In a demand zone, the lines are reversed. We want to buy below current price, so the proximal line in a demand zone is the upper line since it's closest to price, and the distal line is the lower line. It's important to note that supply is always at or above current price, while demand is always found at or below current price. Let's take a look at proximal and distal lines on a chart. In this example of a demand zone in a drop-based rally formation, we start at current price. As you move down to the demand zone, the proximal line drawn is the first line we come to and defines the top of the zone. As we continue down to the bottom of the demand zone, we find our next line, the distal line. Here you see an example of a supply zone in a rally-based drop formation. Since current price is at the bottom of the red candle, we will need to move up to find our supply zone. The first line we come to is the proximal line, which defines the bottom of the zone. And as we move higher to the top of the zone, we find the distal line. In essence, with the proximal and distal lines, we're looking to outline the range of where the unfilled orders sit. Our strategy focuses on finding those high-quality zones where supply and demand are out of balance, because that's where all those unfilled orders are. These supply and demand zones marked off and defined by proximal and distal lines provide us with low risk, high reward, high probability opportunities. Now you know the difference between proximal and distal lines and how to identify them in supply and demand zones. At this point, you should have a basic understanding of the elements which make up the four formations. Two are bullish, the drop-based rally and rally-based rally, and two are bearish, the rally-based drop and the drop-based drop. Now we're going to implement a method to systematically draw the proximal and distal lines around the base. That method is called the base isolation technique. It consists of 3 simple steps to help you mechanically draw the zone lines. This technique can be used to identify the elements of a formation in order to classify the type of formation it is, draw the proximal distal lines around the base, and finally, the base isolation technique will help in evaluating the quality of the zone. We'll look at an example of both a demand zone and a supply zone. To draw a demand zone using the technique, the first step is to mark off the leg out. Going from right to left, we locate the leg out of the formation, which in the case of demand will be a rally. Remember, a rally can be a gap up, one tall green leg candle, or a series of leg candles with consecutive higher closes. Now slide down the candles in the rally until we run into a base candle at the bottom of the rally. Draw a vertical line on top of the first leg out candle of the rally, following the base candles. The second step is to find and mark the leg in. To do this, we will continue to move left on the chart, candle by candle, until we find the leg candle leading into the zone. Once found, draw a second vertical line on top of this last candle of the leg in prior to the base candles. Everything in between these 2 leg candles makes up the base of the demand zone. Now that the base has been isolated between 2 vertical lines, we can easily apply the third step, drawing the proximal and distal lines. Whether the formation is a reversal, a drop-based rally, or a continuation, a rally-based rally, this will determine where to place the distal line. By isolating the base, we see we have a drop on the way in, a base, and a rally on the way out, giving us a DBR. We'll learn how to appropriately place the proximal and distal lines in lessons to follow. Once the proximal and distal lines have been drawn, it is a good idea to delete these vertical marker lines now and keep our charts clean. Let's look at the base isolation technique applied to a supply zone. For step 1, starting on the right side of the formation, we locate the leg out, which in the case of supply will be a drop. Remember, a drop can be one tall red candle or many candles strung together, so long as they have consecutive lower closing prices continuing the drop out in price. Or the move out can even be a gap down. Once the layout is identified, now move up the leg candles of the drop until you run into a base candle at the top of the drop. Draw a vertical line on top of the first leg out candle of the move out that follows a base candle. Step 2, locate and mark off the leg in. To do this, continue to move left on the chart, going candle by candle, until we run into the leg candle leading into the zone, prior to the basing candles. Once found, draw a second vertical line on top of the last leg in candle prior to the base candles. The candle or candles in between the 2 vertical lines makes up the base of the supply zone. For the third step, after isolating the base with the vertical lines, draw the proximal and distal lines around the base. Now, the type of formation, a reversal, rally-based drop, or a continuation, drop-based drop, determines where to place the distal line for the zone. By isolating the base, we see we have a rally on the left side, a base, and a drop on the right side, resulting in a bearish reversal formation, the RBD. We'll learn how to appropriately place the proximal and distal lines in lessons to follow. Once the proximal and distal lines have been drawn, we can delete the vertical lines. And that's it. With this simple set of guidelines, you know how to mechanically isolate the base of a supply or demand zone, identify the type of formation that it is, and draw the proximal and distal lines around it. As you have learned, a zone is outlined by the proximal and distal lines. In this lesson, we're going to talk about the choices we have in placing the proximal line on demand zones and the respective advantages and disadvantages of each one. First, I want you to notice how the distal line is placed at the exact same point in all three of these examples. Unlike the distal line, which is always at the same point, we do have flexibility in where we choose to place the proximal line. In our first example here, the proximal line is drawn at the highest wick of the base. In the second, it is drawn across the highest candle body of the base. And in the third example, we see the proximal line is drawn across the lowest candle body of the base. What's the difference? Why are these three examples labeled more trade / less profit, preferred, and fewer trade / more profit? Let's explain. When it comes time to actually place our trade, we will use the proximal line for our entry price and with the distal line as the guide for our trade failure point where we will place our stop loss. The difference between the entry and the stop loss is called trade risk or sometimes stop size. However, when it comes to proximal line placement, we need to understand that there's a big difference between trade risk and our actual capital risk. For now, just know that a wider zone will not increase our capital risk. We control our risk with position sizing, which we'll discuss in later lessons. In our first example, we have the widest demand zone. That wider zone will increase our chances of getting the position filled because the market will not have to move as far to reach our entry. With a wider zone, the advantage is we will get into more trades. The disadvantage is that we will have a greater stop loss. To accommodate for this, we will trade smaller positions to avoid exceeding our chosen capital risk. Now, remember when we explained reward to risk ratios? Well, essentially, a wider zone is going to negatively affect the reward to risk ratio. With the third example here, we see the proximal line placed very close to the distal line. The advantage here is we will be able to trade larger positions because of smaller trade risk, which means the trade earns more with each penny, each tick that it moves in your direction. Of course, when the trade works out. Another way to put that is the trade's reward to risk ratio is improved by this lower entry point. The disadvantage is it is tough to pick the exact turning point of the market, and with a narrow proximal line placement, we will miss a lot of trades that turn higher in the zone and never reach our entry. So a good balanced choice between these two is the example in the middle. Our preferred placement is to use the highest candle body in the base as our guide for drawing the proximal line. You'll notice that in these examples, we're using a single base candle to make it easier to follow, but we want you to know that a base can consist of multiple candles and often does. Ultimately, when it comes to placing proximal lines, there's no wrong answer. Where you decide to place your proximal line is up to your personality and your trade plan. In this lesson, we're going to show you where to place the distal line for two demand formations, the drop-based rally and the rally-based rally. We'll start with the reversal formation, the drop-based rally. First, we draw in our proximal line. We're going to use the preferred placement and draw the proximal line across the highest base candle body. Remember, it is up to you where to draw the proximal line. Secondly, we draw in the distal line at the lowest price of the entire drop-based rally formation. It could be on the leg in, a base candle, or the leg out candle. In this example, we see that the lowest price comes from the wick of the leg in candle, so we place the distal line here. Here's an example showing a drop-based rally demand zone in an uptrend. Note how there was a strong rally in price when it left the zone, indicating an imbalance between supply and demand, leaving unfilled orders behind at the base. Using our guidelines, the distal and proximal lines have been drawn outlining our zone of unfilled buy orders. If we were to trade this, the entry order would be placed at the proximal line. Let's watch how this plays out. We see that price pulls back into the zone where the order to go long would be filled, then price turned and continued trending higher. We want to be able to consistently spot these kinds of quality zones, which is what we'll uncover through the course. Now let's take a look at the line placement for a continuation formation, the rally-based rally. First, let's draw in our proximal line. We're going to use the preferred placement again and draw the proximal line across the highest base candle body. Next, let's draw in the distal line. Guidelines for the distal line placement on the rally-based rally formation is just slightly different. With this formation, we only use the base candles or the leg out candle. The leg in candle is not used. In this example, we see that the lowest price is on the base candle, so that is where we would draw our distal line. Here's an example showing a rally-based rally demand zone in an uptrend. Note how there was a strong rally in price when it left the zone, showing this imbalance. Buyers exceed the sellers and move price to higher prices. Using our guidelines, the distal and proximal lines have been drawn, outlining our zone of unfilled buy orders. If we were to trade this, the entry order would be placed at the proximal line. Let's see how this plays out. Price retraces back to the zone, filling the buy order, then reverses and continues trending higher. This is another example of how quality demand zones and uptrends tend to hold. So you now know where to place the distal lines for our two bullish formations, the drop-based rally and the rally-based rally. In this lesson, we're going to talk about the choices we have in placing the proximal line on supply zones and the respective advantages and disadvantages of each. First, I want you to notice how the distal line is placed at the exact same point in all three of these examples. Unlike the distal line, which you will learn to place in another lesson, we do have flexibility in where we choose to place the proximal line. In our first example, the proximal line is drawn at the lowest wick of the base. In the second, it's drawn across the lowest candle body of the base. And in the third example, we see the proximal line drawn across the highest candle body of the base. What's the difference? Why are these three examples labeled more trades / less profit, preferred, and fewer trades / more profit? Let's explain. When it comes time to actually place our trade, we will use the proximal line for our entry price with the distal line as the guide for our trade failure point where we will place our stop loss. The difference between the entry and the stop loss is called our trade risk or sometimes stop size. However, when it comes to proximal line placement, we need to understand that there's a big difference between trade risk and our actual capital risk. For now, just know that a wider zone will not increase our capital risk. We control our risk with position sizing, which we'll discuss in later lessons. In our first example, we have the widest supply zone. That wider zone will increase our chances of getting the position filled because the market will not have to move as far to reach our entry. So with a wider zone, the advantage is we will get into more trades and we'll get more action. The disadvantage is that we will have a greater stop loss. To accommodate a greater risk per share, we will trade smaller position sizes to avoid exceeding our chosen capital risk. This will, in essence, negatively affect the reward to risk ratio on the trade. With the third example, we see the proximal line placed very close to the distal line. The advantage here is we will be able to place a larger position on the trade because of the smaller trade risk. So we will profit more with each little bit that price moves in the direction of the trade when the trade works out. The disadvantage is it is tough to pick the exact turning point of the market, and with such a small zone, we may miss a lot of trades that turn from a lower point in the zone, never reaching our entry. So a good, balanced choice between these two is the example here in the middle. Our preferred placement is to use the lowest candle body in the base as our guide for drawing the proximal line. We also want to point out that in these examples, we're using a single base candle to make it easier to follow, but remember, a base can also consist of multiple candles. Ultimately, when it comes to placing proximal line, there is no wrong answer. Where you decide to place your proximal line is up to your personality and your trade plan. In this lesson, we're going to learn where to place the distal line for each of the supply formations, the rally base drop and the drop base drop. Let's start with the reversal formation, the rally base drop. The first step that we want to perform is to draw in our proximal line. As you've already learned, where we draw the proximal line is up to us, so we're going to use the preferred placement and draw the proximal line across the lowest base candle body. The second step is to draw in the distal line at the highest price of the entire rally base drop formation, the most extreme price of the entire reversal. It could be on the leg in, a base candle, or the leg out candle. In this example, we see that the highest price comes from the wick of the leg in candle, so we place the distal line here. Here's an example showing a rally base drop supply zone in a downtrend and how price reacted when it traded back up into the zone. Note how there was a strong drop in price when it left the zone and not a lot of base candles. These are things that we will discuss later that enhance the odds that there are enough unfilled orders in the zone to turn price back lower if it retraces or pulls back up into the zone. We draw in the proximal line at the lowest candle body in the base, and the distal line is drawn at the highest price of the entire formation. Now that we have the zone defined by our proximal and distal lines, we wait for price to return to the zone. Using a proximal entry, we would have entered short here and enjoyed a sharp sell-off. Next, let's take a look at the line placement for a continuation formation, the drop base drop. The first step that we want to perform is to draw in our proximal line. We're going to use the preferred placement and draw the proximal line across the lowest base candle body. The second step is to draw in the distal line. Our guidelines for placing distal lines on a drop base drop formation is slightly different than it is for the rally base drops. With this formation, we only use the base candles or the leg out candle, whichever has the highest price. The leg in candle is not used. In this example, we see that the highest price is on the base candle, so that is where we draw the distal line. Here's an example showing a drop base drop supply zone in a downtrend and how price reacted when it traded back into the zone. Note how there was a strong drop in price when it left the zone and not a lot of base candles. Using our guidelines, the distal and proximal lines have been drawn, outlining our zone of unfilled sell orders. If we were to trade this, our entry order would be placed at the proximal line. So how did this trade turn out? We see that price did retrace back into our zone, filling our order, then turned and continued trending lower. This is another example of how quality supply zones can hold and turn price lower, providing us with high probability trading opportunities. So you now know where to place the distal lines for our two supply zone formations, the rally base drop reversal and the drop base drop continuation. Every trader needs an edge in the markets. In this lesson, we're going to introduce some powerful tools that provide us that edge. Odds enhancers. Odds enhancers help measure the quality of a trade setup and determine its probability of success before you even enter the trade. The odds enhancers are our proprietary way of testing the probability of a zone. The basis of our strategy is looking to buy and sell where the institutions are buying and selling. We know that market prices turn where there's a large pocket of unfilled orders, where supply and demand became out of balance. Odds enhancers compose a robust scoring system that enables traders and investors to objectively measure the quality and probability of an opportunity based on the imbalance between supply and demand and the unfilled orders at the base. These key conditions occurring on a price chart provide a significant advantage in the markets, our edge. Using this scoring system routinely helps methodically plan trades and investments to achieve consistent results in the marketplace. While each is individually important, the real power comes in the entire setup as a whole. Take, for example, a watermelon. You didn't realize, but you already have a set of odds enhancers you use to select a watermelon. You don't just pick out any old watermelon from the bin, do you? No, instead you look at it. Is it green? That's a start. Is it that round or ovally shape? There's 2 checklist items. You listen to it. What is it telling you as you pat the side of the watermelon? Is it summertime? Are you buying it from the organic fruit stand or from the grocery store? I'm sure watermelon farmers have many more. The point is this: the more criteria used, the better sense you have of whether that watermelon is going to be a nice, crisp, sweet watermelon when you cut into it. The same is true here. The more odds enhancers you consider, the better understanding of a trade setup you have, and in turn, the higher the probability the zone has of working out. You decide on the minimum score acceptable to enter a trade based on your personal level of risk aversion and the purpose of your trading. The higher the score, the better the opportunity. The lower the score, potentially the riskier the trade. Now you have a general overview of odds enhancers and how they are used to increase the probability of a successful trade by measuring and scoring the quality of a setup based on supply and demand. The odds enhancers you'll learn here are asset class independent. As you learn about other asset classes, you'll learn additional odds enhancers specific to that asset class. The single most important objective in trading is to be able to consistently identify trading opportunities that have the highest probability of working in your favor should you act upon them. Notice we used the word probability, and with trading, nothing is certain, and the best you can do is stack the odds in your favor to increase the chances of obtaining the outcome you're looking for. Our strategy contains 6 attributes of a trade opportunity or setup that, when present, increase the odds of the trade working in your favor. We call these attributes odds enhancers. You'll frequently hear this phrase odds enhancers throughout your learning journey, so let's take a high-level speed tour of what they're all about. The 6 odds enhancers are organized into 3 different groups. The first group, known as zone structure, contains 3 odds enhancers that help gauge the quality of a zone. They are strength, time, and freshness. The second odds enhancer group is known as context, and it contains trend and curve. The third and final group, known as reward to risk, contains the 6th and final odds enhancer called profit zone. Later in your lessons, we'll dive deep into the definitions and principles of each one of these odds enhancers and learn how they are used within a scoring system to help you decide whether to act upon a trade opportunity or not. Having a rule-based scoring system helps you reduce the emotions in your decision-making process. Each odds enhancer is given a score of 2, 1, a half a point, or 0 based on the condition of that odds enhancer. You'll be taught all the conditions for each odds enhancer, so you'll be equipped to make decisions on trade setups that will stack the odds in your favor. In this lesson, we're going to look at strength, the first of our zone structure odds enhancers. It's the first odds enhancer observed as you go through the zoning process. We'll show you visually what a strong leg out looks like on a chart, as well as how to measure and score for strength. When assessing the probability of a zone, we're essentially assessing if there was a big imbalance with a lot of unfilled orders left behind. The strength odds enhancer refers to how price leaves the base, the leg out of the formation. It's critical we have a strong move out because it demonstrates imbalance, exactly what we're searching for on the charts. As price is basing, essentially buyers and sellers are in balance. Think of a balance scale with an equal weight on each side. The scale will be balanced. What would indicate to you that the weights are not equal or balanced? Well, if one side is lower or higher than the other. Or what would happen if you were to pull some of the weight off of one side? It'll tip slightly in the other direction. But what if you pulled off one of the weights entirely? It would tip sharply. One side will drop quickly and the other side will move up quickly. The sharper the drop, or rally here, the more out of balance the weights are. Well, that's exactly what the strength odds enhancer demonstrates for us. A strong leg out of a base points to an imbalance between buyers and sellers at that base. And the stronger the move out, the more out of balance supply and demand are. Before we even begin to analyze the strength on a quantitative level, it should be visually clear that the move out of the base is strong, with a sharp incline or decline in price, vertical candles up or down leaving the base. With that, there are two main quantitative aspects to assess. First, a strong move out must be one where price rallies from a demand zone or drops from a supply zone by at least 2 times the height of the base. The second element to an explosive move is the breakout. Did the move out cross beyond a previous opposing structure? Let's break that down. The move out begins with the first leg out candle and continues as the series of leg candles with consecutive closing prices in the same direction. For a demand zone, the move out consists of the series of all the leg candles rallying out of the base. For a supply zone, the move out consists of the series of leg candles dropping from the base. It's measured from the proximal line of the zone to the most extreme price of that move out. Did the move out reach a distance of at least twice the height of the base from the proximal to the distal line? The breakout occurring demonstrates a clear winner, that the battle that took place at the base was clearly won by buyers or sellers. For a demand zone, we ask, did the move out break out beyond preceding supply? That could be a supply formation like a rally-based drop or a drop-based drop, or simply a high. For testing the breakout for a supply zone, you look at, did the move out break out beyond a preceding demand structure? That could be a demand zone like a drop-based rally or a rally-based rally, or simply a low. So the strength odds enhancer has a maximum score of 2, 1 point for the move out and 1 point for the breakout. If both criteria are met, a move out equal to or greater than twice the base, and a breakout beyond a preceding opposing zone, then the strength score for the zone is a full 2 points. If the zone only exhibits one of these, either move out or breakout, then the zone scores a 1 out of 2. If it fails to meet both criteria, then it would receive a score of 0 in the strength category. As mentioned in a previous lesson, a zone will be high quality, high probability by demonstrating full marks in not merely one odds enhancer category, but a number of odds enhancers. It's about the full context of the overall setup. We're going to use a working example that we will continue to tally up the score for as we go through each odds enhancer lesson. In this example, we can see visually a very strong leg out of the base. It's eye-catching. Measuring it, price moves out a distance of more than twice the height of the base, garnering 1 point. And secondly, price crossed beyond preceding supply on its way out. This brings the strength score up to a full 2 points total in our scorecard. Now you know how to test and score a supply or demand zone using the odds enhancer of strength, the 2 key components of an explosive move, and what it looks like on a price chart. While it's the first odds enhancer observed for a zone, let's remember, the more odds enhancers you use, the better probability of a successful trade. In this lesson, we're going to look at time, the second of our 3 zone structure odds enhancers. We'll show you how to measure and score for it, and also what it looks like on a price chart. The odds enhancer of time measures how long price spends basing at a supply or demand zone. A short time spent basing at a zone suggests more unfilled orders at the base. A long time spent at the base suggests fewer unfilled orders. Imagine a battle between 2 armies, the Red Army and the Green Army. And let's say we line up soldier for soldier. If there's 1,000 soldiers on the Red Army and 800 soldiers on the Green Army, then the Red Army will win and will advance. However, at the end of the battle, they're a pretty weak unit. They're bruised and exhausted, and if another opposing army comes along to fight this Red Army, they're going to get run over unless reinforcements come in. Now let's look at a second scenario of still 1,000 soldiers on the Red Army, but this time we have 300 soldiers on the Green Army. As in the first scenario, the Red Army will win, but this time they have 700 soldiers left. They're still a pretty strong army. They could probably win another battle if and when opposition comes along. Now replace armies with sellers and buyers. In the first battle scenario, sellers still will win the battle, but with a fair amount of buyers, the 2 sides are more balanced, more orders are filled, leaving behind less unfilled orders. And the time that it takes to fill those orders is much longer than the second scenario, where sellers win the battle. But with few opposition on the other side, on the buy side, price leaves too soon for the sellers to get their orders filled, leaving behind more unfilled orders. A candle represents a unit of time on a time-based chart. Time is measured by the number of basing candles. The fewer candles, the better. To score for time, you simply count the number of base candles at the zone. If a supply or demand zone has between 1 and 3 base candles, the zone gets a score of 1. If between 4 and 6 basing candles, the score gets a half a point in the time category. And if there are more than 6 base candles at the zone, it scores a 0 for time at the zone. It's important to note that while the fewer candles, the better, there has to be at least 1 base candle. In essence, we want to see that there was a little battle, a little accumulation of orders, but that price leaves too quickly for all the orders to get filled, leaving behind more unfilled orders. In our working example, there's only 1 base candle in the zone, indicating price spent a very short amount of time there. Based on our scoring method for time, since there's between 1 and 3 basing candles, this zone gets a full score of 1 point. Adding this to our scorecard, including the strength and the time odds enhancers, we're at a running total of 3 points for this zone. Now you know how to test and score a supply or demand zone using the odds enhancer of time, and how to assess time on a price chart. Remember, the more odds enhancers you use to score a zone, the greater the opportunity of the zone working out for you. In this lesson, we're going to look at freshness, the third and final of our 3 zone structure odds enhancers. We'll define freshness, explain its importance, show you how to determine the freshness of a zone on a price chart, and how to score for freshness as well. While your typical definition of something fresh is something recent, that's not exactly what our definition of fresh is. Freshness for our purposes refers to price returning to the zone, or another way to say that is price testing the zone. When looking for opportunities on a price chart with a high probability of turning price, we're looking to identify a big stack of unfilled orders. More unfilled orders remain at a base which has not been tested. A zone which is not fresh suggests fewer unfilled orders at a base because as a zone is tested, pending orders get filled, decreasing the unfilled orders at the base. And consequently, this reduces the likelihood of price turning in that zone on a subsequent retracement back to the base. Before we dive into the scoring of freshness, let's define a few related terms. The freshness odds enhancer is the measure of how far, if at all, price has entered the zone. A fresh zone is one that has not been tested at all. Candles print at the prices where orders fill. So if after the initial move out of the zone, the moment where the unfilled orders are left behind, no candles have printed within the zone lines, then none of those orders could have been filled, aka more unfilled orders. A zone is not fresh once price has pierced the proximal line. If following the initial leg out of the zone, you see the print of a candle inside the zone, then orders have filled at the prices in that zone, which consequently reduces the size of that stack of unfilled orders. And if price has gone completely through the distal line, the zone is violated. If a zone is violated, price has cleared any unfilled orders at the base. So at the point the zone is violated, when price crosses the distal line, the zone is considered disqualified. To score for freshness, we measure how far, if at all, price has tested the zone. The freshest zone is one where price has not tested the zone. Price has not retraced back to the zone. This would receive the highest score of 2 points. If price comes back to a supply or demand zone, it'll get a 1 or a 0 depending on how far into the zone it retraces. If it only retraces 50% or less into the zone, then the zone gets a freshness score of 1. If price has tested into the zone more than 50% up to the distal line, it gets a freshness score of 0. The deeper price goes into the zone, usually that indicates there are fewer unfilled orders within the zone. Looking at the zone in our working example, prior to the first test, this is a fresh zone. Prior to the first test, this zone gets a highest score of 2 for freshness. You can think of it like this. If you're entering the trade at the first test of the zone, then the zone gets a 2 for freshness. Adding this to our scorecard, a 2 for freshness takes the total score for this zone to 5. Now you know how to test and score a supply or demand zone using the odds enhancer for freshness and what a strong fresh zone looks like on a price chart. This rounds off our zone structure odds enhancers of strength, time, and freshness. As you can see, the zone structure is only half of the recipe. We'll fill in the remaining half of the scorecard as we learn to assess the overall contextual elements of the trade setup. Adding in all ingredients to the odds enhancers pie will provide the highest probability opportunity. Conventional technical analysis teaches us that we should be using support and resistance lines on our charts. However, there's a huge problem with this approach. Among the pitfalls of support and resistance trading, such as false breakouts and running stops, picking a support and resistance line means that you're anticipating that price is going to turn at that exact price to the penny. That's probably not going to happen. What's more likely to happen is a price will turn in a zone, a window between two prices. In this lesson, we're going to define what a zone is and what are some of the benefits of using zones. A zone is simply a region on a chart that is marked by proximal and distal lines around the price window where supply and demand became out of balance. By defining our zones in this way, it provides us with much more flexibility on how to construct our trade. As you've seen, there are two types of zones, supply zones and demand zones. Here are some of the advantages of using these defined supply and demand zones. First, they provide low-risk entry points, allowing us to minimize our losses. The reason we say that it is low risk is because in the process of mapping out our zones, we're identifying an area with unfilled buy or sell orders which could turn price. While we will refine our risk with a stop loss later on, the risk involved in the trade is based on the width of the zone, a small, confined window representing low risk. They also provide high reward potential, which can lead to greater profit. That is to say, we can read the profit potential for the trade prior to entering the trade, and it's in our control to select zones that offer us sufficient reward to risk on the trade. Since we're identifying where institutions are buying and selling, it also provides high probability for buying at wholesale and selling at retail. As you start to learn more about the trend, you'll notice how most retail investors are buying at all-time highs or selling at lows. Having defined supply and demand zones visually tells us whether we are buying at wholesale or retail prices. And finally, it establishes the foundation for a simple, rules-based strategy. Let's face it, the reason that many people fail at trading is because they don't have rules and they change their process on every trade they make. By having a specific set of steps to follow, you'll reduce the chance of making mistakes. As you'll see shortly, the zoning process is not that difficult. It's a simple 5-step process that you'll be using to identify both supply and demand zones on any time frame and for any asset class you'll be trading or investing in. Now you have a better understanding of why the zoning process is important. Next, let's dive into that process. We know the formations that define a demand zone and a supply zone. We know how to isolate the base using the base isolation technique, and we know how to place proximal and distal lines for all 4 formations. We've also learned the zone structure odds enhancers to qualify the formation. Now let's bring all of this together in a simple 5-step zoning process to identify and qualify supply and demand zones. In the following lessons, we're going to look at the 5-step zoning process for each of the 4 formations. Let's begin with the first of our 2 demand zone formations, the drop base rally. The first step in identifying any zone starts with current price, the candle that's farthest to the right on the chart. That's our starting point because we know demand is at or below current price. So we find that first candle to orient ourselves on the chart. Now think, what element of the formation defines it as demand? That's right, the big rally, since an explosive rally in price indicates an imbalance towards the demand side. So step 2 is to look down and left until you find an explosive rally in price. Now that we've found the zone, let's draw it. Step 3 will be to apply the base isolation technique, 1 vertical line on the leg out and 1 on the leg in. Pause here to identify the formation. In this example, you can see a drop base rally. Now that we've identified the formation, that brings us to step 4, placing the proximal and distal lines. We found the zone, drew the zone, now let's evaluate the zone. In step 5, we score the formation using the zone structure odds enhancers of strength, time, and freshness. For the strength, the zone has a move out of at least twice the base, and the move out breaks out above preceding supply, above this high right here. For time at the zone, there's only 1 basing candle. And for freshness, there have been 0 retracements. Using this scorecard, the score for the zone, 2 for strength, 1 for time, 2 for freshness, brings the total odds enhancer score so far to 5 out of 10. Now you know the 5-step process for identifying demand zones with the example of a drop base rally. Though it's 5 steps, we can categorize that into 3 blocks. Find the zone, draw the zone, score the zone. Be the zone. You are the zone. In the following lessons, we'll apply this process with examples of the remaining 3 demand and supply formations. We've seen the 5-step zoning process demonstrated for a drop base rally. In this lesson, let's apply the same 5-step zoning process with our second demand formation, the rally base rally. We'll begin at step 1 with current price, the candle farthest to the right on the chart. In step 2, look down and left until you find an explosive rally in price, big green candles. Step 3, apply the base isolation technique, 1 vertical line on the first leg out candle, a second vertical line on the last leg in candle. After isolating the base, we can identify the formation as a rally base rally. Now that we've identified the formation, we move on to step 4, placing the proximal and distal lines around the base. Finally, in step 5, score the formation using the zone structure odds enhancers. For the strength, the leg out moves out more than twice the distance of the base, and the leg out breaks out above the preceding supply right here. For time, there's one base candle in between the vertical lines. And for freshness, price hasn't retraced back to the base. Filling in the scorecard, the zone gets a 2 for strength, 1 for time, 2 for freshness, a total of 5 out of 10 so far for the odds enhancer score. In this lesson, we demonstrated the 5-step zoning process to identifying a demand zone with the example of the rally-based rally formation. With that, you've seen both bullish formations, the DBR and RBR, identified and qualified. It's time to move on to identifying supply zones in our next lessons. We've looked at the 5-step zoning process for our demand formations. Now let's look at the zoning process for supply. You'll notice it's going to be very similar to that of demand, using the base isolation technique and qualifying the formation with only minor adjustments to the steps to accommodate supply zones instead of demand zones. Remember, find the zone, draw the zone, score the zone. Let's look at an example using the rally-based drop. First step in finding the zone is to start by locating current price, the most recent candle on the right-hand side of the chart. Step 2, since supply is above current price, look up and left until you find an explosive drop in price. Remember, an explosive drop in price indicates an imbalance towards the supply side. You found it, now draw it. Step 3, apply the base isolation technique with 2 vertical lines on the first leg out candle and the last leg in candle. Then identify the formation here, a rally-based drop. And step 4, place the proximal and distal lines. Last but definitely not least, score it out. Step 5, score the zone structure odds enhancers, strength, time, and freshness. For the strength, the zone has a move out of at least twice the base, and the move out breaks out below preceding demand, below this swing low right here. For time at the zone, there's only one basing candle, and for freshness, price has not retraced back to the base since the zone was created after that leg out. So with that, using the scorecard, the zone gets a 2 for strength, 1 for time, 2 for freshness, bringing the odds enhancers score to 5 out of 10 for these first 3 odds enhancers. In this lesson, you've learned the zoning process to find a supply zone with the example of a rally-based drop. As you can see, it's not too different from the demand side, it's just flipped, since supply and demand are opposites. In the next lesson, we'll look at an example of a drop-based drop. Now that we've learned the zoning process for a supply zone, let's look at an example of a drop-based drop. You know the drill by now. Step 1, start with current price. Then step 2, look up and left until you find an explosive drop in price, big red candles. Step 3, apply the base isolation technique to identify the formation. We have a drop in the way in, base in the middle, and a drop on the way out, a DBD. Now that we've identified the formation, in step 4, place the proximal and distal lines. Lastly, in step 5, it's time to score the formation. For strength, the move out is at least double the distance of the base, and the move out breaks out below preceding demand to the left. For time at the zone, there's only 2 basing candles, and for freshness, the base has not been touched since the zone was formed. Filling out the scorecard, the zone gets 2 for strength, 1 for time, and 2 for freshness, bringing the total odds enhancers scores so far to 5 out of 10. In this lesson, we demonstrated the zoning process for finding supply with the example of a drop-based drop. The process is the same for both supply formations. You're looking for that sharp fall in price with a cluster of small candles at the top of the drop. Whether the leg in is a rally or a drop, it doesn't really matter. The important thing is that steep drop. This rounds out our lessons on the zoning process. You've learned the 5-step process for both demand and supply. Just keep in mind it's really three things: find the zone, draw the zone, and score the zone. So now let's go find some zones on our charts. So we've put it all together. We not only learned about the four formations, but we're beginning to develop the skill to identify and qualify these formations consistently on a price chart. We have four formations with 3 elements each. 2 are bullish, 2 are bearish, and in this lesson, let's review each formation one at a time. Let's start on the supply side with the rally base drop. The RBD occurs when price rises, moves sideways, and then drops out of the sideways basing. It's considered a reversal formation because in creating the formation, price reverses directions. The second bearish formation is the drop base drop. It occurs when price pauses as it's dropping, leaving behind some unfilled institutional sell orders. The DBD is a continuation formation because, unlike the rally base drop, the formation is created by a drop, followed by basing, and ultimately falling out of the base, in essence, continuing the movement down in price. In both formations, the drop from the base signals that buyers have been taken out by the sellers, demonstrating an imbalance towards the sellers who are controlling the price move and ultimately leaving behind some unfilled institutional sell orders at the base. The action with a supply formation is to sell short at or inside the zone. Now for the demand side. A rally-based rally occurs when price moves up, begins to base, then rallies on out of the basing. Because price continues to move out of the base in the same direction it was moving in prior to basing, the RBR is a continuation formation. Whereas the other bullish formation, the drop-based rally, is a reversal formation. It reverses direction in creating the formation. Price drops, then bases sideways, and then turns and begins to rally. Price moving higher out of the base indicates there are no more institutional sellers in the base. Remember, price can only move higher when all of the sellers are cleared out. Since the leg out is a rally, it must mean that the sellers were cleared out at the origin of the rally, and there must have been more buyers than sellers, leaving behind unfilled buy orders at the bottom of the rally. The action with a demand formation is to buy at or inside the zone. So we have 4 formations, each with 3 elements. 2 are bullish, 2 are bearish, 2 are reversals, 2 are continuations. And going forward, we'll apply the zoning process we just learned to find 1 formation at a time. In this trend overview lesson, we're going to walk you through how trends work, develop, and the cycles they can run in. Think of trend like the wind, a force pushing you in a specific direction. Let me ask you, is it going to be easier to move with the wind at your back or to be fighting a headwind? With a tailwind, you're going to go farther, faster. With a strong headwind, you're going nowhere anytime soon. When we combine supply and demand with trend, it can increase the probability of finding low risk, high reward, high probability trading opportunities. Our rule-based strategy combines supply and demand, where to buy and sell, with market trends, when to be a buyer or seller. It's how professional traders do it. It's how we do it. Trend tells us which direction to expect the market to go. This can increase the probability of making more profitable trades since it lets you know the right times and wrong times to buy or sell. Trend refers to the direction price is currently moving in and likely to continue to move. Let me just pause on that for a moment. This is a huge value that the trend provides. You're always looking to buy low and sell high, and you do that by being right on the direction price is going to move in. The trend is direction, and what's more, trends tend to continue. So in this way, the trend is an odds enhancer, one of the tools you will use to increase the probability of the trade working out in your favor. Trends can be defined as either up, down, or sideways. Historically, market cycles run in 4 stages, progressing through each of the 3 trends. The first stage on the left starts with a sideways trend when price stays relatively within the same range of highs and lows, and traders are both buying long and selling short, or potentially waiting for a price to break out into an uptrend or downtrend. As the market starts to move, it heads to the second stage, the uptrend. An uptrend is made up of higher lows and higher highs, with the trading bias to buy long. From there, price tends to move into another period of sideways trending before the fourth stage, the downtrend. The downtrend is made up of lower highs and lower lows with the trading bias to sell short. After that, it's usually back to another sideways trend. Note that the sideways trends are the same. The only differences are their stages in the market cycle and the direction they move into or out of, an uptrend or downtrend. As you'll see in future lessons, trends are built with 2 components, impulsions and corrections. These elements clue us into where the trend is most likely to go. They can be found connected together between reversals. Here's a nice representation of a couple strong trends and reversals. Notice how during the uptrend, prices continued to push higher with very little pullback. Same thing for the downtrend, strong moves down with very little movement up during the downtrend. These are the characteristics of trend, giving us some more pieces which may help us succeed. Now you have a basic understanding of trends and the 4 stages a market cycles through. Trends are key in determining in which direction to take trades, long or short. In upcoming lessons, we'll learn the components of a trend, how to identify trend on a chart, and the strategy in each trend environment. A trend is a series of impulsive and corrective moves connected together between reversals. In this lesson, we're going to focus on the impulsions of a trend. Looking at this chart, we have a long-term uptrend, and that uptrend is stair-stepping higher with steep bursts up and occasional small steps back down where the market consolidates before continuing higher. Eventually, it runs out of buyers and the uptrend runs its course. Once the sellers exceed the buyers, we see the demand and supply relationship shifts in favor of the sellers, which then results in a steep and significant dropout in price. So the impulsion phase is typically the dominant direction of the trend. In an uptrend, the impulsions are the movement up. The characteristics we'd normally see would be the same color candles, green, moving up in one direction. The movement is characteristically sharp and steep. In a downtrend, the impulsive moves are the steep red candles moving down. Those candles are often referred to as high speed and can be described as powerful, relentless, and persistent movement in price, demonstrating people's trust in the trend. There's commitment to the trend direction. Following the impulsion phases of a trend is following the path of least resistance. This concept of the path of least resistance speaks to the idea that a market is going to move in the direction where the imbalance is greatest. As an example, in an uptrend, the buyers exceed the sellers. There's an absence of sellers, and the price will continue higher. As a result, the movement in price with the trend has the tendency to easily violate opposing zones in lower time frames. This is something we'll want to look out for because now that we've learned about our 4 core formations and how to identify a supply or demand zone, it will be in our nature to see a market moving up and automatically think that we should go back on the chart, look to the left, and find a place to be a seller in a supply zone, or to see the market falling and automatically think that we should look for a place to be a buyer at a demand zone. That's because at that point, that's the type of zone that price will be closest to. And we're itching to get into trades, right? But before we make that decision, we want to look at the market and see which is the dominant direction so that we're joining the largest flow of money in the market and that path of least resistance. So with trend analysis, we can take examples and visually identify the impulsion phases. In this uptrend on the left, we have very steep and short-lived upward movements. These are the impulsion phases of the uptrend, and you'll notice that the candles are mainly green, mainly all one color. On the right, we have a downtrend, and you see the tallest, sharpest movements on price are red. We've highlighted these movements with trend boxes to aid us visually in seeing the characteristic difference between the up and down moves in different trending environments. In this lesson, we've learned what the impulsion phases of a trend are, along with key characteristics to help identify them. In the next lesson, we'll learn about their counterpart, the correction. We looked at the impulsion phases of a trend, so in this lesson, we'll talk about the correction phases. The correction phase is actually what's found in between impulsions. It's the reversion to the mean, or the pullback from the primary impulsive direction. In an uptrend, the corrective phases are the down or sideways moves, and in a downtrend, the up or sideways moves. Those areas, the correction phases, are typically slower, covering less up and down price movement. They're very choppy or zigzaggy, and a lot of time is eaten up by the corrections. If you're a really good range trader, which we'll learn about, then you'll find that these would potentially be the market environments in which you could make a lot of trades for short distances. As we learn to tie it all together, we can follow the series of impulsions and corrections in what's called a swing trade manner to ride the trend through the phases for larger profits and a better reward to risk ratio. We've already looked at the impulsion phases in our example, and that was the steepest movements in price. In between the impulsions, you'll find the corrections. Look at the characteristic of these candles. What you'll notice is the candles tend to be multicolored. Most of the candles in an impulsion phase tend to be the same color, while the candles in a correction phase tend to be different colors, with choppy, corrective activity. Sometimes it's just sideways. Sometimes it's back in the opposite direction of the impulsion. Here in the correction phase of the downtrend, you'll notice the green boxes represent the characteristics of sideways or retracement movement. So the combination of impulsion and correction gives us the key characteristics of the trend components. It's our job to enter a trade as late in time, as in the last moment in time, before the correction turns back into an impulsion. That's our goal as traders. Once a trend has been established, to join that trend, we want to join in the correction phase before the next impulsion phase begins. We'll show you the mechanics of that strategy a little later. In this lesson, we learned what the correction phases of a trend are and key differences in their nature as compared to the impulsion phases, which will help us to identify trend. Understanding these differences allows us to time the markets better when combined with supply and demand zones. We've discussed market cycles and defined the impulsion and correction phases of the trend. In this lesson, we'll explain the basic components of trends: swing lows, swing highs, up segments, and down segments. The question we always ask ourselves is, where is the market most likely to turn next? So let's start by looking back at where the market has already turned. We need something to anchor off of, and that is where markets have gone from down to up or from up to down. We call those swings, or you may hear them referred to as pivots. A swing low occurs where price stops falling and starts rising. Often, a drop-based rally is found at these swing lows. On a line chart, a swing low looks like this, and on a candlestick chart, this is how it's represented. The swing low itself is the lowest price of the turn. A swing high is just the opposite, where prices stop rising, turn, and start to drop. Again, here's what a swing high looks like as a line chart, and this is how a swing high is represented as candles on a price chart. Often, a rally-based drop occurs at the swing high. The swing high is the point at which the market has risen to its highest. So what we want to do after we have swings established, swing lows and swing highs, is to connect those swings. When we connect those swings, when price moves from a swing low to the following swing high, or from a swing high to the following swing low, these moves in price can be referred to as segments. Segments may also be described as ranges. If we were just talking math, a line segment or a range is simply a line between 2 points. So the movement between the point of the swing low to the point of the swing high, or vice versa, is simply a segment. An up segment is the range of price movement from a swing low to a swing high. And we can see that here with the candles. The lowest point on the left to the highest point on the right makes the up segment or up range. Now let's talk about down segments. A down segment is the range of price movement from a swing high down to the following swing low. It's just the opposite of an up segment. Now let's remember that price moves from left to right. Even though we look at charts generally from right to left, from the current price back, we have to remember, where did the market come from? With the candles, we see the highest point on the left to the lowest point that follows to the right forms the down segment. In this lesson, we defined a swing low and high and up and down segments. In the coming lessons, we'll look at how these basic components of the charts combine to form trends. In the most basic definition, an uptrend is just a series of prices moving upward, and a downtrend is just price moving down. But that's not good enough for us. As we dive deeper into trends, you'll notice that there are some basic building blocks for trends which must be broken down. In the previous lessons, we learned about swing highs and lows and how they connect to create segments. As we move into the lessons on each individual trend, up, down, or sideways, we'll look at how segments connect to form trend. The simplest way to approach trend analysis is to focus on a series of segments, 3 or more. While trends indicate consistent movement of price in a direction, there are pullbacks or corrections retracing in the opposite direction of the dominant trend. Think about it. To determine if the lows are getting higher or lower, what's the minimum number of lows that you would need? The minimum would be 2. And to figure out if the highs are getting higher or lower, what's the minimum number you would need? The minimum is again 2 for comparison purposes. So in total, the minimum number would be 4 points, 2 highs and 2 lows to determine the trend direction. If you connect the dots, you get 3 segments in between 4 points. So a 3-segment approach makes sense. Let's look at the basic elements of the 3 different trends. Uptrends are comprised of higher swing lows and higher swing highs. As you can see here, we have segment 1, which is a strong impulse move to the upside. Segment 2 is a correction which does not reach the prior low. And segment 3 is another impulse move up which breaks the previous high. A downtrend is comprised of lower highs and lower lows. As you can see here, we have segment 1, which is a strong impulse down. Segment 2 is a correction which does not reach the prior high. And finally, segment 3 is another impulse move lower, which breaks the previous low. Sideways trends show relatively equal highs and lows in price. Sideways trends may also occur with conflicting highs and lows, either higher highs but lower lows, or lower highs and higher lows. These are a little trickier market conditions, but we'll get into some of those details later. It's important we understand that a trend is made up of 3 segments, not just one, because often we'll see a few of the recent candles dropping and figure price is in a downtrend, when in reality it could be just a minor pullback within the context of an overall uptrend. So with that in mind, we don't want to assume the trend direction based on one segment alone. Now you have a basic overview of how swing highs and lows and up and down segments form trend. In the next lessons, we'll look at the specific combination of segments that form an uptrend, downtrend, and sideways trend. Let's talk about uptrends. In this lesson, we'll define an uptrend and explain key components. In an uptrend, prices are consistently moving to higher prices because demand exceeds supply. It continues to reflect that an imbalance exists where the number of sellers becomes zero and buyers continue to buy, pushing prices higher even more. The buyers are in control in an uptrend. The swing lows are holding the security up from dropping to lower prices. One of the hallmarks present in an uptrend are higher highs and higher lows. Helping that happen are the strong impulsions or up segments and mild corrections down or sideways. With uptrends, we are looking to buy at qualified demand zones. So the question is, when does an uptrend begin? An uptrend always starts with a low since it has to go up from somewhere. In this illustration, you can see price making a low, then moving back up to make a high. Then price drops back down, it makes an equal or higher low. The moment price crosses above the high, even one tick higher, is the moment an uptrend is born. If you think about it, as price breaks out above the high, it's already mathematically higher. So the uptrend is official as soon as price crosses above the high, and at that point, the focus is on buying long. Notice there are 3 segments here, which makes sense because, as we learned, any trend consists of 3 segments. In the case of an uptrend, it begins with an up segment, followed by a down segment that doesn't cross below the preceding low, followed by an up segment that travels above the swing high of the preceding down segment. Let's define a couple key components of the uptrend: the controlling swing low and the breakout segment. Uptrends occur because institutions are buying, and the large flow of money is to the upside. As price trends up, the lows become equal or higher, showing that the buyers are controlling a certain price level and moving the markets higher. Therefore, the lows control. The controlling swing low of an uptrend is, by definition, the most recent higher low that has a breakout. Looking at candlesticks, we see we have an uptrend from the low to the high, then from the high to the higher low, and then price does what? It crosses above the high. A breakout occurs. When that breakout occurs, the higher low becomes the swing or pivot in control of that uptrend. The trend is controlled by that higher low, which means something very significant to us, because if price ever goes below that point, then the trend would be terminated. We'll learn about when an uptrend is terminated in the following lesson, but let's keep in mind that the controlling swing low of the uptrend is very significant to us in our determination of the trend and the current market environment. Since an uptrend may have multiple swing lows if it has been trending for some time, let's be more explicit. The controlling swing low of the uptrend is the lowest swing low that's located between the nearest high and the breakout of that high. Now, the breakout segment of the uptrend is connected to the controlling swing low. It's the entire up segment starting from the controlling swing low up to the following swing high. Determining the breakout segment of the trend is particularly important because that will play into our strategic decision of where we want to find demand zones to join the trend. So in summary, while an uptrend always begins at a low, it isn't official until price makes a higher or equal low and then a breakout occurs above the previous high. For a confirmed uptrend, we define the key components: the controlling swing low and the breakout segment, which combined with supply and demand zones will determine where we engage an uptrending market. Every trend has a beginning, middle, and end. In this lesson, we'll look at the formation, continuation, and termination of an uptrend. As we learned in the previous lesson, a trend consists of 3 segments. The formation of an uptrend always begins with an up segment, starting from a swing low to a swing high. That's followed by a down segment that does not cross below the preceding swing low, a sign that buying is coming into the market. And after that higher low, an up segment that breaks out, where price crosses above the preceding swing high. The last segment on the right is the breakout segment, and the higher low is the controlling swing low of the newly formed uptrend at this point. The uptrend continues every time the market continues to make higher lows and higher highs. Each time the price crosses above the high and a new higher low has been created, that new higher low becomes the controlling swing low of the uptrend. As you'll notice here, the original higher low is no longer the pivot in control because the new high has been broken, and therefore the new higher low is the swing in control. Price remaining above the controlling swing low and breaking above the highs tells us the trend is continuing. Then the market makes a new high. Once price crosses above that high, and not until that moment, then the new higher low becomes the controlling swing. So you notice that the controlling swing low of the uptrend is adjusted to higher lows as the trend continues to make higher lows and higher highs. Why do you think we put such an emphasis on the controlling swing low of the uptrend? Well, answer this question. Would the market still be in an uptrend if price crosses below the controlling swing low? No, it can't be, because at that point, the market would be making a lower low. And by definition, an uptrend is not made of lower lows. So once price crosses below the controlling swing low, then the uptrend is terminated. Once the trend has terminated, how would we classify the movement of price from the very first low of the uptrend to the very last high of the uptrend? It's no longer a trend because the uptrend terminated, but it doesn't just vanish. It's still an object on the chart. So if it doesn't represent a trend anymore, what does it represent? A terminated uptrend reverts to a range. Let's remember that a range is simply a low to a high. So the terminated uptrend reverts to a range from the first low of the trend on the left to the last high on the right. Once the trend has terminated, it's no longer the dominant direction of price. While we haven't fully defined downtrends yet, notice that something that resembles a downtrend has formed before the uptrend actually terminated. It's important you know that a trend terminates on its own. It has nothing to do with an opposite trend forming. The most recent controlling swing low is the price that must be crossed in order for the uptrend to terminate, regardless of a sideways or downtrend developing prior to price breaking below the swing in control. On the contrary, just because an uptrend terminates doesn't automatically mean that a downtrend has begun. So to reiterate, a trend terminates on its own, uniquely, having nothing to do with an opposite trend forming. Now you know the full story of the uptrend, the beginning, the middle, and the end. Being able to identify the formation of an uptrend, the continuation of the uptrend and the adjustment of the controlling swing low, and finally the termination of the uptrend will help us in our decision-making process for entering trades. We can follow a simple step-by-step process to identify a trend. Starting with an uptrend, since we understand how an uptrend forms, continues, and terminates from left to right, we can now go all the way to the far right of the current price on the chart and work our way backward into the 3 segments defining the current trend. In this lesson, we'll learn how to determine the most current trend through the trend identification process. So step 1, going from right to left, we start with current price. Then in step 2, look down and left until we identify the most recent swing low and draw a vertical line on the low. And then step 3, continue down and left to find an equal or lower swing low and draw a second vertical line on that low. Step 4 takes us somewhere between these two lines. By drawing these vertical lines, it gives us a sideways boundary in which we've isolated a set of candles. Find the highest price among the isolated candles in between these two vertical lines and plot a horizontal line on that price. Next, in step 5, we have to ask ourselves 2 questions. A, did the price cross above the high isolated between the two lows? In this case, yes, it did. So that's what creates a trend. But we still want to know B, has the price crossed back below the higher low? If no, then we have a valid uptrend that has not been terminated. So what we have here are 3 segments. We have a low to a high to a low, and a low to a high. And 2 conditions. 1, price broke above the high, and 2, the higher low has never been crossed. With all of that determined, you officially have an uptrend. Now it's a matter of what we do with that. We're not there yet, but that's where we're headed. So an easy way to see the trend is to draw each segment of the trend by connecting the swing highs and swing lows. We can either draw trend lines or boxes to see the trend. It's your choice. The important thing is that you clearly understand what price is doing. So we'll place a green trend box on up segments and a red trend box on down segments, with a trend line as well connecting the low and high of each segment. What do you notice about the boxes? That's right, the green boxes are taller than the red boxes. Is it really that easy to identify the trend? All we have to do is draw colored boxes and determine which ones, if any, are taller. Of course, it's linear and mathematical with a low, high, higher low, and a break to the upside. But by drawing out the segments, we can visually see that the green boxes are taller. The up segments are the impulsions, and the green box on the right goes above the red box preceding it, demonstrating the breakout and making that particular segment the breakout segment of the uptrend. Now, did anyone see the connection of the trend boxes to our 4 formations? Look at it for a second, and what do you notice about the pattern of boxes? Don't the boxes look sort of like a rally-based rally? That's a little food for thought for what's to come as we begin to combine some of the major topics of supply and demand zones with trend, but keep that in the back of your mind for now. It's important when you're drawing the trend boxes and lines that they connect on one corner, because where one segment ends, the next begins. We need to be precise in the placement of these boxes and lines to aid us visually in identifying the trend. So with that, here are the trend identification process quick steps. 3 simple steps to identify the trend. First, start with current price. Second, draw the 3 most recent segments using trend boxes or trend lines or both, whatever you choose. And lastly, in step 3, evaluate the trend and confirm it's valid. When price broke out, the trend was formed. And since price hasn't crossed the controlling swing low, the trend is still valid. It hasn't been terminated. The breakout segment is the green box on the right, as the impulsion phase that is connected to the swing in control. Note that if a market is currently in the corrective phase of a trend, then drawing 3 segments would only take you back to the previous corrective phase and wouldn't give us a defined uptrend. So there may be some instances in which you'll need to draw a 4th segment in step 2 to identify the current trend. That's it. You've learned what defines an uptrend, how an uptrend forms, continues, and terminates. And finally, in this lesson, you learned the steps that identify a current trend. All that's left is to practice finding some uptrends. Let's talk about downtrends. In this lesson, we'll define a downtrend and explain key components. It's simply a mirror image of the uptrend. In a downtrend, prices are consistently moving to lower prices because supply exceeds demand. Downtrends reflect that an imbalance exists, the sellers exceed the buyers, and when the buyers go to zero, this allows the sellers free movement, giving way to the market moving lower. The sellers are in control in a downtrend, so the emphasis is on the highs. This is illustrated with lower highs and lower lows on the price chart. During a downtrend, we should see strong impulse moves on the down segments and small corrections up or sideways, including mixed colored candles. We look to sell short in downtrends at qualified supply zones. Let's start with when a downtrend begins. A downtrend starts with a high. Moving from left to right, it starts with a high point, a low point follows, then an equal or lower high, and then the market begins to move down. As soon as a breakout occurs below the low, that's the moment a downtrend is official. So the downtrend is born as soon as price crosses below the low, and at that point, the focus is on selling short. Notice there are 3 segments here, which makes sense because, as we learned, any trend consists of 3 segments. In the case of a downtrend, it begins with a down segment, followed by an up segment that doesn't cross above the preceding high, followed by a down segment that drops below the low of the preceding up segment. Let's define the swing in control and the breakout segment of the downtrend. Downtrends occur because institutions are selling, and the large flow of money is to the downside. As price trends down, the highs become equal or lower, showing that the sellers are controlling a certain price level and moving the markets lower. Therefore, the highs control. The controlling swing high of a downtrend is not the highest high in the trend, but the lower high that's followed by a breakout. Looking at this chart, we see we have a high, a low, a lower high, and then price crosses below the low. At this point, once the market breaks out to the downside, the lower high becomes the controlling swing high of the downtrend. Why is that important? As you learned with uptrends, we have continuation and termination of trends that hinge on the swing or pivot in control. If price ever goes above that lower high, then the trend would be terminated. It's the line in the sand. A downtrend may have multiple swing highs. It's important to know which is the swing in control. The controlling swing high of the downtrend is the highest swing high located between the breakout and the swing low that was crossed. Now, the breakout segment is the segment that begins from the lower high and, go figure, it breaks out. It's the impulsion phase connected to the controlling swing high, that entire string of candles in the down segment starting from the controlling swing high to the following swing low. Identifying the breakout segment of the trend will be important to determine where we want to find supply zones to sell short with the trend. So in summary, while a downtrend always begins at a high, it isn't official until price makes a lower or equal high and then a breakout occurs below the previous low. For a confirmed downtrend, we define the key components, the controlling swing high and the breakout segment, which combined with supply and demand zones will play into our strategic decision of where to join a downtrending market. In this lesson, we'll look at the life cycle of a downtrend, the formation, continuation, and termination. As we learned in the previous lesson, a trend consists of 3 segments. The formation of a downtrend always begins with a down segment starting from a swing high down to a swing low. That's followed by an up segment that does not cross above the preceding swing high. That's a sign that selling is coming into the market. And number 3, a down segment that breaks out, where price crosses below the preceding swing low. It just needs to cross the low by 1 penny, 1 tick, or 1 pip to confirm the downtrend. The last down segment on the right is the breakout segment, and the lower high at this point is the controlling swing high of the newly formed downtrend. That downtrend continues every time the market continues to make lower highs and lower lows. Each time price crosses below the low and a new lower high has been created, that new lower high becomes the controlling swing high of the downtrend. As you'll notice here, the original lower high is no longer in control because the new low has been broken, and therefore the new lower high is the swing in control. Price remaining below the controlling swing high and breaking below the lows tells us the trend is continuing down. Then the market makes a new low. Once price crosses below that low, and not until that moment, then the new lower high becomes the swing in control. Notice that the controlling swing high of the downtrend changes as the trend continues. We'll get into strategy a bit later, but keep in mind that trends tend to continue, and as they do, the swing in control moves with it. Why do you think we put such an emphasis on the swing in control? Well, for starters, it's what we'll anchor our entry points off of. But answer another question. Would the markets still be in a downtrend if price crosses above the controlling swing high? Well, no, it can't be, because at that point, the market would be making a higher high, which by definition is not part of a downtrend. So once the controlling swing high is broken, then we know that Arnold Schwarzenegger showed up to the party because the downtrend is terminated. Once terminated, how would we classify the movement of price from the first high of the downtrend to the last low of the downtrend before it terminated? It's no longer a trend, but it doesn't just disappear from the chart. So if it doesn't represent a trend anymore, it reverts to a down range. Remember that a range is simply a low to a high or a high to a low. Once the trend has terminated, it's no longer the dominant direction of price. You'll notice that an uptrend has formed before the downtrend actually terminated. Keep in mind, the most recent controlling swing high is the price that must be broken in order for the downtrend to terminate, regardless of a sideways or uptrend developing prior to price crossing above the swing in control. On the contrary, just because a downtrend terminates doesn't automatically mean that an uptrend has begun. So to reiterate, a trend terminates on its own, uniquely, having nothing to do with an opposite trend forming. Now you know the full story of the downtrend, the beginning, the middle, and end. Being able to identify the formation of a downtrend, the continuation of the downtrend and the adjustment of the controlling swing high, and finally, the termination of the downtrend will help us in our decision-making process for entering trades. We've learned the step-by-step process to identify an uptrend, so in this lesson, we'll apply the trend identification process for a downtrend. It's really the exact same, just the end result is a downtrend instead of an uptrend. So step 1, going from right to left, we start with current price. Then in step 2, track price back to identify the most recent swing high and draw a vertical line on the high. And then step 3, continue up and left to find an equal or higher swing high and draw a second vertical line. Step 4 takes us somewhere between these two lines. By drawing the vertical lines, it gives us a sideways boundary in which we've isolated a set of candles. Find the lowest price among these isolated candles in between the two vertical lines and plot a horizontal line on that price. Next, in step 5, we have to ask ourselves 2 questions. A, did the price cross below the low isolated between the vertical lines? In this case, yes, it did. So that's what creates the trend. But we still want to know, B, has price crossed back above the lower high? If no, then we have a valid downtrend that has not been terminated. So what we have here are 3 segments. We have a high to a low, back to a high, and then down to a low. But instead of moving from left to right, starting at a random point in the past and wondering when we would get to the end of this trend, we can start from current price on the right of the chart and back our way into the current trend. As long as when we back our way in, we have those 3 segments defined with a high, low, lower high, and a break of the low, and the lower high has not been crossed, then you have a downtrend. Now it's a matter of what we do with that. We're not there yet, but that's where we're headed. So with lower highs and lower lows, we have an official downtrend. So an easy way to see the trend is to draw each segment of the trend by connecting the swing highs and swing lows. We can either draw trend lines or trend boxes to see the trend. As we learned in the previous lesson on uptrends, it doesn't matter which you use, they both get the job done. So use whichever helps you see the trend correctly. We'll place a green trend box on up segments and a red trend box on down segments, with a trend line as well connecting the low and high of each segment. What do you notice about the boxes? This time, the red boxes are taller than the green box. The trend is confirmed as down with the high, low, lower high, and a breakout below. But by drawing out the segments, we can visually see that the red boxes are taller. The down segments are the impulsions, and the red box on the right goes below the green box preceding it, demonstrating the breakout and making that particular segment the breakout segment of the downtrend. Now, did you see the connection of the trend boxes to our 4 formations this time? Look at it for a second, and what do you notice about the pattern of boxes? Don't the boxes look sort of like a drop-based drop? That's a little food for thought for what's to come as we begin to combine some of the major topics of supply and demand zones with trend, but keep that in the back of your mind for now. It's important when you're drawing the trend boxes and lines that they connect on one corner, because where one segment ends, the next begins. We need to be precise in the placement of these boxes and lines to aid us visually in identifying the trend. So with that, here are the trend identification process quick steps, 3 simple steps to identify the trend. First, start with current price. Second, draw the 3 most recent segments using trend boxes or trend lines or both, whatever you choose. And lastly, in step 3, evaluate the trend and confirm it's valid. Since price broke out, the trend was formed. Since price hasn't crossed the controlling swing high, the trend is still valid and hasn't been terminated. The breakout segment is the red box on the right as the impulsion phase that is connected to the swing in control. Note that if a market is currently in the corrective phase of a trend, then drawing 3 segments would only take you back to the previous corrective phase and wouldn't give us a defined downtrend. So there may be some instances in which you'll need to draw a 4th segment in step 2 to identify the current trend. That's it. In these lessons, you've learned what defines a downtrend, how a downtrend forms, continues, and terminates, and finally, the steps of the trend identification process to identify and confirm the current trend. All that's left is to practice finding some downtrends. Last but not least is the sideways trend. In this lesson, we'll talk about the unique condition in the markets, which is a sideways trend, otherwise known as ranging. In a sideways trend, supply and demand are relatively balanced, and therefore price is contained within a range. This range represents a period of consolidation and could be a wide range or a tight range. Ranging markets tend to expand and contract, but you'll notice that we don't really see breakout segments like we had with uptrends and downtrends. With a sideways trend, we see relatively equal highs and lows remaining within a range. In any ranging market, we'd look to trade at the extremes. In other words, we'd look to sell near the highs and we'd look to buy near the lows. For sideways trends, we'll apply the exact same science as we did with uptrends and downtrends, which is to look at 3 segments. While we need 3 segments to define a trend as sideways, it could have more if it's been ranging for a bit. It begins with either an up or down segment, followed by a segment in the opposite direction that doesn't break out, and finally a third segment that is also contained. Now there can be expanding ranges, and that's a bit more of an advanced trend market condition, but just know that it exists. Typically, however, the ranges of the 3 segments would be contained within one another. Here's an example of a sideways trend. Starting at the far right, we've drawn a box that represents the most recent segment, which is up, a green box. Backing up from that to the highest point preceding, we see that we have a down segment, a red box. And what precedes that is a green box from a low to a high. So we have a sideways ranging market, a small, medium, and a large box going from right to left. In other words, as the market continues to move from left to right, the far left segment, the green box, engulfs the middle segment, the red box, and the middle segment engulfs the far right segment, the green box. And it shows us a consolidation is occurring. And there we are. You've learned in this lesson about sideways trends, which wraps up the definitions of each trend. Now it's time to talk strategy. Once we find the trend, what do we do with that? That's what we'll cover in the next lessons.